that in there.
No, it was just a video. Welcome in, everybody. It's Tesla earnings. Happy Tesla earnings day. I have Herbert here from Brighter with Herbert. We'll be doing a big old show today with a bunch of us in the room. Just a heads up, my dog got out a few minutes ago, and the whole family, I have my parents and my parents' friends all trying to chase him with producer wife. So right now it's just me and Herbert. I may have to step away depending on the situation, just to give you a heads up. So Herbert, if I have to step away, would you mind just taking over for a little bit?
You bet. I'll do that.
Thank you,
problem.
Brother. Thank you.
Yeah.
So where's your head at, man? Maybe give yourself an introduction to the audience. I think this is the first time I've had you on my channel, if I remember correctly.
It is the first time. Thank you guys. Thank you very much. So my name is Herbert. I do have a YouTube channel called Brighter with Herbert, and I also cover Tesla. I have a Twitter account called @HerbertOng, and I think what makes me different is I'm a startup founder. I've grew up with product management. So the way I look at Tesla is more at the business level, at the product level. In my Twitter, what I'm known for is I'm the milestones guy. So I keep track of all the activities that Tesla's doing, both past and the future. And then with my channel, basically I do interviews. I talk to anybody that teaches me. I can make them a little bit brighter. So that's a little bit about me. I invested in Tesla 2012. So it's one of those things that I'm all in now after about a year ago. So I look at it differently. I'm a long-term investor. I don't do momentum. I've dabbled in options, but I'm not going to do that anymore. I think that, the long-term strategy is really the way to go at this. So that's a bit about me. Yeah.
Awesome, man. Thank you for the intro. Yeah, it's always cool getting to sort of know some of the long-term folks that have been out there. I think there's a lot of folks from back in 2012, 2013, even before then, that sort of saw this story developing. And now we're more than 10 years later, and it's still sort of captivating a lot of people. And it's just so cool to see it grow in scope and becoming more and more mainstream. So what are you expecting in about half an hour, Herbert? This is probably one of the most anticipated quarterly earnings reports out there for Tesla that I can remember in a while. What are you expecting? What are you looking for? Yeah. Are you pooping your pants, or are you just as calm as a cucumber? How are you feeling?
I am calm as a cucumber because, like I said, it's not about this quarter and others. I've seen your tweets recently. I absolutely agree with everything you're saying about just, it's all about strategy. But I actually do think that we're going to see margins at 20%. And the reason I do, auto gross margin, because, they found them.
Other dogs. Oh, who knows? We'll see if it's the right one.
Because, okay, here's why I'm thinking this way. So Zach, in January, he was asked the question, what's your guidance? And he said, I think we'll still be able to hit 20% auto gross margin, right? And I think what he saw that no one else can see, not us or anybody else, is they have very clear visibility into supply chain costs, in the minerals costs, and their transportation costs, and the efficiency of their gigafactories. So he already knew in January that they were going to be able to hit this number. And as the months go by, of course, we're starting to see the inflation numbers. We're seeing things fall dramatically. They were ahead of that game. So it's a question of whether or not you trust what management has been saying, and if you still believe them or you don't. If you've lost your confidence and you don't trust what they say, then of course you have the right to have a different opinion on all this. But I do think that I very much believe that when they say something like this, that there's reasons why they did. Now, it's barring macro. So anytime that they've been off, it's always because something happened in the macro environment that caused them to get off. So I still think they're going to hit their 20% margin. I'm very happy with the price cut. So I'd love to get Matt and Emmett here and talk to them about the issues with the price cuts. But I'm pretty excited about it. I think that the company is absolutely kicking it in every way, right? The new factory in the Megafac factory in Giga Shanghai, every factory is now getting up to speed and efficient. The announcement of the price cuts really solidifies their market share and gain. I don't think that there has been any demand issues. So if we want to start talking about is there a demand, is that why they're causing the price cuts? Or not, I don't think so. But I am very curious of why they did their price cuts last night as opposed to waiting the next few days. And we should probably talk about that.
Great. No, thank you for your insight there. We have the ugliest person I've ever seen in my life, Matt Smith, joining the live stream. Actually, you look very handsome today. What's with those glasses, bro? Is that for like a need or a stylish choice?
So they're my computer glasses. I do use these when I'm staring at like numbers in great detail. They're like the what are they called? Like the blue screen or whatever. Yeah, I get kind of headaches when I'm digging too much into uh, numbers without them on. So
I
yeah,
see. Well, it's
more
definitely
it's my
helping. It's
bookmark.
definitely helping. Yeah.
Matt, can you not make the camera a little bit closer to you so that you don't look so small?
No,
on the
we don't
screen
want
there?
that. No. We want him as far away.
Come on, Matt. I want to see.
I can get closer. I can do that.
Yeah.
Yeah. Show us your
I
nose
might
hairs. We're
switch over. I'm in my sitting studio for a little bit here. I may switch over to my normal part in a little minute here.
No problem. Whenever you need to. So what? Yeah. Where's your head at? Obviously, a lot going on. The report's going to drop here in about half an hour. What are you thinking through? Maybe any response to Herbert's sort of claims around pricing and demand, or whatever else is going through your mind?
Yeah, I mean, we had a kind of long Twitter Spaces on it earlier today that Emmett hosted. My thinking is, Elon in January was basically saying, I want to put this demand concern to rest, like for the final
Mhm.
time. And at that time, he said, you know what, look, our order rate is twice as much as our production rate right now, so we don't have a demand problem. And that's not the case anymore. Like objectively looking at the data, looking at the backlogs shrinking, looking at the wait times shrinking, inventory rising, especially on Model X. It just seems like you'd have to be really stretching for some kind of plausible scenario where demand hasn't shrunk, or at least it's not keeping pace with the rate of increase of production. So demand is a concern. That's why I think the stock is where it is right now. And the question that all the Wall Street analysts and frankly I think it's a legitimate one are asking right now is what's going to happen to margins. I mean, how many more price cuts do you need? And what's going to happen to those margins if the price cuts aren't supported by cost of goods sold decreases? So Emmett's joining us chili? What's that about?
What is that? What's chili? You having some chili right now, or what's going on?
That's what my kids team called me as coach. I'm one of the parent coaches on my kids first grade baseball team, and I said my nickname is Chili. Last name is Peppers. So.
Well, isn't that the most brilliant thing I've ever heard? Well. Okay, let's introduce the next folks here that have just joined us. We have Chili Peppers from not the band Red Hot Chili Peppers. Emmett Peppers from Good Soil, great fan of the show. We also have Nicholas Gibbs, Nick Gibbs, my boy down in somewhere, and Jeff Lutz. Jeff, I believe this is your first time on the channel as well. Welcome in. Jeff was and Herbert were both on a space this morning related to Tesla and finance. And I was up there as a speaker as well. But then Herbert and Jeff were carrying the conversation so beautifully. I'm just gonna listen, bro. I'm just gonna let him. Just gonna listen the whole time. It was just absolutely brilliant. So Jeff, maybe give yourself an introduction to my audience. I don't think in case folks aren't aware with your background, because you are a brilliant individual. Absolutely.
No, thanks. It's great to be with everyone on here too. A lot of really smart people. And I've been a Tesla investor since 2012, 2013, and I've been an owner as well since then as well. And in terms of background, executive in supply chain for a couple of decades in high tech. You can look at my Twitter profile, and I retired a number of years ago, maybe 5-6 years ago, and I started my own consulting firm where I'm working with mega cap tech companies today on supply chain design, unit economics, COGS, you name it. So a lot of things I see a lot of parallels in the discussion regarding gross margins and COGS, and maybe just not enough discussion on modeling COGS and understanding where COGS could be. So happy to provide some input in that.
Awesome. Thank you, Jeff. Now, Matt was talking about, and Herbert were talking about pricing. They were talking about some of the latest moves around, how pricing is, Herbert's saying doesn't think that it's so much related to demand. Matt thinks that it is related to demand. And there's obviously a lot of complexities and nuance in that discussion. Any of the three that have just joined us, Nicholas, Jeff, or Chili, do you guys have any thoughts around that topic that you guys want to share?
Pricing and demand.
Yep. Especially with the latest pricing decreases that we just saw in the market.
Yeah, I mean, we were on a big spaces. I really think I'll just reiterate that To me, it dumbfounds me why Tesla seems to refuse to spend something to educate the public. Baby boomer generation in particular has no idea how to buy Teslas. They end up going to other places, buying other cars. Lots of anecdotal stories of this. Uber drivers constantly tweeting me saying, "Yeah, I drive an Uber. No one understands what a Tesla." So I feel like there's a huge opportunity to make many, 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 many more people aware of how affordable Teslas are, and how easy they are to use, and so forth. And it's really just, we're ignoring that, and lowering prices just captures the young, tech folks who can't quite afford it yet, but are educated on it, and so there's a huge pie of people that can afford it now, but just are not educated on what Teslas are.
Jeff or Nicholas, any thoughts around that?
I'll let Nicholas go.
Yeah, I'm kind of in the. Can you guys hear me? Okay, do a mic check real quick. All right. Yeah, I'm also kind of in the in the camp of. I think it has some to do with demand. Not because Tesla has any issues or anything. I think it's just macros in general. I mean, I think people. I mean, I'm doing it. Right? I'm hoarding cash. My best friend, really wealthy individual, he's hoarding cash. It's kind of the thing people are doing right now. And I think dropping prices, it's not just for people who can't afford it, but it's also for people who are, maybe just trying to be more frugal with their capital right now, because we don't know what's going to come in the next, 6 to 18 months. So, but I definitely think, I definitely think that this is not an issue for Tesla. I think it's just where we are in the cycle of the big story. For all we know, prices could go up in the future again. So it ebbs and flows.
Yeah, I'm on board with that too. I see this as a point in time. I see us, and from working with companies over the last several years, COVID. If you're outside of building and shipping electronics or large devices in volume, what was called the COVID economies had a massive impact on raw materials, had a massive impact on the supply base in really three fundamental areas. One was labor. Labor was, from a scarcity perspective, was a problem, so that drove rates up. Not so much probably in Tesla's four walls, but at their suppliers for sure. And so there was some burden due to that. The second thing was on commodities. A lot of the commodities spiked. Almost all of them spiked, and they stayed there for a fair period of time. Now, the way contracts are written for a company like Tesla, like they're not going to see every ebb and flow of every single daily spot price on aluminum or copper. But if it's up for an extended period of time, it's going to be an issue. And then the third thing was the big area. There's many areas, but the third thing was around logistics. And so all these different areas, logistics was probably a 10 to 100x multiplier at various points of time and various freight lanes, depending on what you're using, where you're shipping from. So what's Tesla done over that 2-year period? Number one, they had to raise their prices to deal with COVID economies. If you look at the Model Y, which is the highest volume Tesla being built at a 3-to-1 rate, they started raising those prices about 8 quarters ago, and it was right at where it is today. It came right back to it, but it was at $49,990. And over those 8 quarters, they took the pricing up precipitously to deal with these quote unquote COVID economies. Now what's happened? Many of those commodities have started to roll over and have come down precipitously. 1, 2, people are back to work. And while there are still scarcity issues with labor, it's improved. And the third thing that's rolled over is on the logistics side significantly. And then what else has Tesla done during that 8-quarter period? They've reformed their own internal logistics in terms of localization, where they build cars versus where the customer is, and also where their supply base is relative to where they build cars. Remember, when you stand up Austin or you stand up Berlin, all of your suppliers aren't stood up at the same time. So, and then when those factories were running and building only 1,000, 500 units a week, 200 a week, 1,000, that factory was literally, like Elon used the term, a furnace from a cost structure perspective. So I think Tesla very smartly used those last 8 quarters of time, number one, to get their localization in place, deal with the cost spike in economies, also take the Model Y run rate from 250,000 units annualized 8 quarters ago to where it is today, right around 1.3 million units annualized if you look at the Q2 run rate. And so they've been able to scale their supply base, widen that pipe 5x in the process of doing that. And basically they brought their prices, their cost, and they brought their prices to consumers back to where they started from their initial quarter of launch, which is the worst COGS structure you'll ever experience in the lifetime of a product.
Anybody want to add or? No, it was great. It was fantastic. Anyone want to piggyback or add anything to what Jeff just said?
I would say that's a good point, that the costs, I've heard this, a couple of times, the costs have come back down to where they were, when the Model Y was first introduced. But at that time, that was before inflation of, 20%, versus, prices are like 10 or 20% higher across the board for everything now versus then. So you sort of have to build that into that comparison, I would say. Also, back then, whenever they start ramping up production of any car, it's always at the high. It should be assumed it's at the, a price point that is going to be high. I would say you have to build that into the discussion too. Anyway. Sorry.
But look at any consumer discretionary product, like a phone, for example. If you get a 2-year-old phone new, you're not paying the 2-year-old pricing. You're paying some number a lot lower. And I think it's very difficult for autos to maintain their MSRPs, over 8 quarters. Again, it is a supply demand dynamic. And by the way, I'm not denying that there would be pockets of demand issues occurring. What I'm trying to say is, Tesla is kind of aligning to their mission, which was like, these costs have to come up in order for us to stay in business and deal with COVID and inflation. Got it. But as soon as we're able to bring them down through scaling our supply chain and ourselves, as well as those commodities rolling over, they're going to bring them down. And then as they're bringing them down, they're going to purposefully slot and design in new products with a unit economic structure that are slightly lower to where the long range Model Y is, and where the a little bit probably below where the standard range 3 is. We'll see what they actually release. But I think in the back half of this year, and they started with the Model Y standard, is purposely slotting cars that have a unit economics build up at a lower price point versus just degrading the existing products in the portfolio.
Mm-hmm. So I want to clarify when I said that it's not a demand problem. I just meant to say that it's not this massive demand problem. The company's in massive trouble. They need to now do, across the board global price cuts. And just like Jeff was saying, I absolutely agree that there's going to be pockets of demand issues. And what I love about Tesla is they do variable pricing, and because they sell direct to consumer. Let me ask you guys this question though. What happens? I'm really curious why they did the price cuts last night, the day before earnings. And so let's go through a couple mind experiments here, thought experiments, right? So let's say that we did not have COVID. If COVID didn't happen, they launched the Model 3 in 2018 and Model Y in 2020. COVID doesn't happen. They had their price points, which is what the price is today, and they had over 20% gross margins for both of those. And I got you. I know, Chili, you were saying that that there's the prices still have gone up, some things. But if COVID didn't happen, wouldn't have Tesla continued with their now growing gigafactory scalability, everything, all the things we talked about?
I would say you're absolutely right, but Tesla would be a $250 billion market cap company right now. It would never have gotten to a trillion market cap.
Agreed. So we're not in a growth environment, and that's why there's an issue that we're today. But so there's the recession, and we can talk about this, but Jeff and I have been talking about this quite a bit, that during a recession, Tesla is actually is much better positioned because they can buy things at a cheaper price. They can negotiate with their suppliers better and so forth. So it feels to me that the price cuts that they did, why do last night? So if they had terrible margins today, we'll find out in half an hour, 10 minutes. Why would they have done the price cuts last night?
To rip the Band-Aid off, maybe?
Yeah, I mean,
I don't know.
A number of extremes. Yeah.
Last time they
I don't
did
think
the price cuts a little bit before the Q4 earnings call, and then they had some preliminary data on demand that they shared on the thing. So, I think it probably has something to do with the fact that they want to have some information to share on the call. But honestly, it's not enough time. You can have 12 hours of of sale data to share.
Mm-hmm.
So I don't know. It's an interesting question. But
yeah, I'm not a big.
Yashu. How you doing?
Yeah.
Hey, Yashers, you're looking good, man. I've never seen you with a suit on. You look good.
For real.
Thanks, Al.
That's
Thanks,
all the
Al.
show.
Commercial
hat?
real estate buildings or what?
Yes, yes. No, how's it going, guys? It's a great conversation.
Good.
I've been listening. Emmett, awesome Twitter Spaces this morning. First of all, I want to say hi. It's been a while since I've seen all you guys. But let's talk about price cuts, right? Because yesterday, Herbert, you're asking why do it last night. I think that's exactly it. Rip the Band-Aid off. If they were to print 19% gross margin XF credits today after hours, and then they announce further price cuts, it's kind of like a double whammy. You might as well precede it and then let everyone see how the margins land today, which I'm not super optimistic on in terms of where they're going to land. But it almost kind of sucks because I thought quarter one call was going to be like the massive call where we're going to find out how low can gross margins go. And then it seems like throughout the quarter, we've continued to see cuts. So it's really going to be Q2 when we see kind of more of the gross margin actually hit the bottom line / cost reductions, which everyone seems to think there's this massive cost reduction in the last quarter. I hope I'm wrong, but it just seems like it's too early to tell at the moment.
Yeah. Let's do Nicholas and then Jeff.
I agree with everything Yashu just said. I don't think things have made it through that quickly. I mean, if you ever worked anything in a supply chain type industry, this takes a while for things to go through. I mean, just look how slow interest rates are hitting the economy or having an effect, right? And here we're talking about price of goods. But I don't know how much of a timed plan thing this is as far as cuts before earnings. I mean, I don't know. I mean, we've had price cuts before and those aren't timed for anything. So I kind of think they kind of just happen. They're on their own cycle. I think it'd be very anti-Tesla culture to be thinking such short-term things and trying to, gamify things that much. But then again, I also think the whole scrub of the launch the other day was also intentional. So, I mean, maybe I'm wrong.
What?
Go ahead, Jeff.
Yeah. No, just in terms of how cost reductions can work. So some things are fast, some things are really fast. Like if you move a logistics lane, for example, if you take something out of Shanghai and say, I'm going to build it in Berlin and I'm going to distribute it for Germany, like that's an immediate thing. Also, logistics rates can also move pretty quickly, but those are also negotiated in blocks as well. So I don't believe Tesla saw a massive knife edge brunt of cost increases, but I also don't believe there's going to be this massive, peak or drop off, but there's definitely a reduction that's been happening over the last couple of quarters. I see this as well. So I believe that's happened. The other thing that they were able to do over the last year, while there was all this noise around COVID, is fill up Berlin and fill up Austin. And they're not full, right? But they're over their halfway points. So from a cost structure perspective, your cost structure, you burn your cost structure based on your line install capacity and how much labor you brought in and trained. So the fact they seem to be running pretty efficiently. They're doubling every 3 to 4 months or so in terms of those factories. So that tells me that they brought that cost structure down significantly. So they were actually able to leverage this COVID economies situation where they had to raise MSRPs and they were able to actually ramp 2 gigantic facilities while it's happening. So it's actually a very good thing for Tesla. But I would say over 8 quarters of production, the last time they're at this price point to now, they've probably, I mean, they've 5x'd volume. They're up 500% on the Model Y. It's gone from a 250K run rate to 1.3 million. So I'd have to think that they're getting over maybe 2%, if not more, over 2% per quarter deflation. Again, that's normalized for commodities, so you have to see where they're at. But I believe they've been able to do significant COGS reduction, and they showed us what they did over about five years or so on the Model 3 during Investor Day. Again, that was net of commodities, but they showed us what they were able to do.
Real quick,
So
we're
I actually go ahead.
Sorry, Matt, go ahead. No, please.
Well, I was just going to say, I actually agree with everything that Jeff has been saying, except that I've been expecting the same kind of improvements to show up over the last 2 quarters and haven't really been there. So, talking about kind of compounded quarterly improvements from 8 quarters ago, like that makes sense in theory. But then when you look at, Q3 and Q4 actual cost of goods sold versus what we might expect in Q1, I mean, there's not a huge increase in deliveries. I mean, we increased maybe 20,000 vehicles in Q4 relative to Q1, or sorry, Q1 relative to Q4. And the cost structure did not come down significantly in Q4. So like, I agree with you, Jeff, that all those trends seem to be there, and I hope I'm wrong and they kind of come to a head. But I find it easier to look at things sequentially rather than kind of the overall trend, which kind of makes sense in theory, but maybe a bit gets lost in the noise.
Well, the Q4, yeah, no, I get your point, Matt. I say the Q4 COGS is a lot of the material they bought in Q3 and Q2. One of the things that happened during the COVID economies is you actually had to lock in, your lead times grew, right? Because scarcity of material grew, lead times actually grew. Tesla's not inept to that or not immune to that. And and same thing on the logistics side as well. So when you look at the Q4 COGS, you're still dealing with a lot of errant cost issues that have happened over the prior quarter. So again, I think this is a bit of a coiled spring. I think there's going to be some compression in margins this quarter and next quarter. I don't think it's some dramatic thing where it's going to 0 or 5 or 10%, but there's going to be some compression. I believe their guidance, but maybe it's within a few percent of it. I don't think that's the end of the world when you're running a supply chain and you're shipping this many billions in revenue. But I do believe if they can stabilize pricing, it can improve. Their gross margins will improve progressively over quarters, just based on the actions they're taking and what's actually happening in commodities right now.
So real quick, as we approach market close, let's go down the line, starting with Herbert and finishing with Yashu. What is your expected gross margin, excluding ZEV credits and leases, for the auto sector for Tesla? If you have an estimate.
Yeah, I started off this call saying that I still actually believe that they'll hit the 20% at the minimum for auto gross margin.
Matt, what about you?
If you maybe go on, I can get you the actual number here. I just pulled up my model, so maybe have somebody else go first.
Mr.
I can just pick. I put my finger in the air and I say 20%.
Jeff?
Yeah, I believe between 20 and 21.
Nick?
Are these Price is Right rules?
Price is Right.
Yeah,
Price is Right rules. Yeah. We have Yashu on the call, so it has to be Price is Right rule.
Yeah. All right. Then I say 21 and a half.
Yashu?
I'm tempted to say 1% if it's Price is Right rules. I think I think publicly I replied to Farzad. I think I replied to you last month, and I said if Tesla hits the 20% gross margin XF credits, I'll shut up about advertising for a little bit. So I feel like because I said that, I feel like they're going to hit 20-something% XF credit. So, but to save face, I'll say 19.9.
Matt Smith.
So I just checked. I'm at 20.6%.
Can I add one thing real quick? Is I think since these more recent price cuts, especially, I think this number is not as important as what people interpret the guidance for margins to be, or the absence of the guidance could be even more worrisome. So
Agreed.
I think that's the big focal point here is, what do people read between the lines as going forward? The margins, is it going to be well below 20% going forward?
So,
Well said.
but don't you think the sort of the number coming in? So, say the number comes in at like 21, ex Zev and lease. Isn't that enough sort of data point that says, okay, now we understand why these guys are just dropping prices left and right? Wouldn't that be the signal?
Nah, I don't think so.
You need more color.
Yeah, I think because a lot of the price cut, a lot of this 20, whatever the print is for this quarter, is before the most latest price cuts. And you have a lot of higher sold cars at the beginning of last quarter than at the end of last quarter, versus now this quarter the cars sold from this point forward are even lower. So I think people are going to wonder, well, we just chopped off another 10% off the price since then. Is that going to be 10% of gross margins or 5% of gross margins, or what? Like, how much are they really lowering the cost of goods sold?
Yeah, I agree. I think it would have been had they not lowered prices last night again. So that's what I kind of mean by I'm saying, like, it's kind of like kick the can down the road for the final decision on how bad these price cuts are going to hit the bottom line. But I mean, as a buyer, I by the way, I have to run here, but I just want to leave you guys on this anecdote. Today I was talking with someone. She's an Audi e-tron driver. She got it 6 months ago, and I'm talking with her, and we're talking about EVs and talking about stalls and charging and stuff like that. This is 100% true story. I'm not making this up.
Oh my gosh, I know how it's going to go. Keep going.
Anyway, so we get to talking, and she's talking about her range, which is surprisingly low for Audi. And feel free to interrupt me if the shareholder that comes out. And we start talking about the supercharger, and I just realized, like, I'm filling her in on stuff that Tesla has that, for example, in this case, Audi doesn't. And it's just like, oh, I didn't know that. Oh, interesting. I wasn't aware of, like, the supercharging network was this fast. And so it seems like this is a sophisticated EV buyer, someone that's gone out, spent their hard-earned money on an Audi e-tron. And yet we can see, and this is nothing against her, she's an awesome person. The point I'm trying to make is that Tesla can do a better job at educating people, even if they are EV buyers, of their advantages that they have. So that's my only point of that story. I have to run out, but awesome to see everyone. Thanks for the live stream, Farzad, and 19.9%.
All right, we'll see. Price is Right rules. Thank you, Yashu.
Right.
Make sure you go check him out on Hit That Bid. We'll make sure to put a link to his channel in the description below. He runs an amazing YouTube channel. So we have producer wife in the background there, F5ing, refreshing the page every few seconds, because we're all addicts and we're all crazy people. So this is what we do on a Wednesday afternoon. I ran 2 polls real quick. I don't know if you guys would find this interesting, but let me go ahead. I'm going to share my screen for a hot second, producer wife, and then I'll throw it over to you. So I ran 2 polls on Twitter. One was an argument out there is that folks that own Teslas are quite upset about the latest price decreases. Please select below the choice that most closely resembles how you feel. Of course, this is not scientific. So 2200. It's out.
Tesla
okay, I'm going to shut up.
Earnings.
Let's see what's happening. The stock is slightly going up. It's going up. Let's see.
85 cents per share. EPS.
All right.
Gap.
Now
Wall Street
coming back down. Stock's coming back down. It might just be zigzag. Maybe it'll be a non-event for the stock price. We'll see. Hard to say.
Okay, so Gap gross margins is 19.3.
Wow.
That's not good.
Gap.
Stock's coming down now.
85 cents earnings per share.
I still can't pull up the thing.
I'm just watching the ticker kind of move up and down here in the chart. I'm trying to see.
Go out, click on the deck, on the shareholder deck, babe. We'll go back to the page. And then click it on the. You're on the wrong screen. So I'm going through the deck right now, and we'll make sure to pull it up. There we go. Perfect. All right. So go to page 4. Perfect. Okay. So there you go. So in Q1 2023, 19.3. Now this is, correct me if I'm wrong, but the guidance from Zach from Q4 was that they were expecting 20% margins, or they were modeling for 20% margins and ASPs above 47,000, right? And I think there was some, I don't know, folks were talking about, they weren't sure if that was for the whole year or for the whole quarter, but for Q1, it's 19.3% gap. So excluding ZEV credits and leases, I'll tell you exactly what it is in a second. And then we'll start going through the report here. How's the stock doing?
Down 178.
Much.
Not too much.
28?
We'll see where the trend goes. Sometimes it takes a few minutes to hit a trend. We'll see if it rebounds or goes back down further. Who knows?
Well, while you do that math, Farzad, just to talk to your poll you had up. So my best friend who I mentioned earlier, his significant other, she bought a Tesla a week and a half ago. And he was texting me saying, "Man, did you see they just dropped prices? I don't have the heart to tell her." But on that same note, my wife in our little group text asked him, "So you think about buying one now?" And he sends a screenshot immediately, like not even a second goes by of it sitting there in the order cart. He's like, "I just have to press the button." Just sitting here looking at it all day. So, I think people are looking to buy as these prices come down, and I do think some people, be a little trying to choose my words carefully here, upset about it.
We had a pretty big jump in energy, it looks like.
Any info on the mega packs or anything?
Not yet. Let me see.
I always like to look at the outlook.
A huge increase in storage deployment. So they were at 2.5 gigawatt hours in Q4. They're at 3.9 in Q1. And at pretty good margins too. I didn't do the math on the margins yet, but it's like roughly 200 million in energy margins, which is actually what we were forecasting of it. So looks like we got the beginnings of pretty strong growth on the energy side. So it'd be interesting to see if they talk about that in more detail, because it does seem like the kind of like the early parts of the S curve. They're both on kind of scaling revenues, but more importantly, profitably.
So the auto margin excluding ZEF and lease is 18.3. ASPs are 44.6. And then COGS are down 3% quarter over quarter from 38 to 36.4. Wait, that's more than 3%. What is this? All is off of the delta. There we go. As you guys are going through the report, what else is jumping out? Yeah, so COGS are down 4% quarter over quarter.
I think the big one, there's a negative foreign exchange impact of $800 million, which I was not expecting. Actually, sorry, that's just on the revenue side. So I'm sure part of that will get adjusted out on the cost of goods sold side too. But that was pretty significant.
How's this talk, Emmett?
It's around 178 still. We got as low as 177, back to 178. I'm just looking at that. I always like to go to the outlook first. I don't know. I go to like end of emails or when I'm looking at informational stuff. I'm looking at the outlook, and it seems like they're signaling to me, reading between the lines, that automotive gross margins are going to continue to go down. That's what I'm
reading. Go ahead and read that page. Sorry, Herbert, go ahead.
No, but they're still guiding for 50% CAGR target. So
yeah,
okay, yeah. Let's go ahead and pull up page 10.
1.8 million. So that's still the same.
Yeah.
So
okay, so let's go ahead and read this along. So,
look at where they talk about profit.
So under the profit section, while we continue to execute on innovations to reduce the cost of manufacturing and operations over time, we expect our hardware-related profits to be accompanied with an acceleration of software-related profits. We continue to believe that our operating margin will remain among the highest in the industry. Operating margins.
They're focusing on operating margin because they think that FSD is going to come to fruition soon. I mean, maybe it will, but if it doesn't, it's not good news to me in terms of automotive gross margins just going down, and software margins not coming up magically.
Where did you read? Where are you getting that you think automotive gross margins going down? When I read that sentence, what he just read, I didn't hear what you're hearing.
I read when they say we expect our hardware-related profits. That's what I read as automotive gross margins to be accompanied, like the lowering of auto gross margins, to be accompanied with an acceleration of software-related profits. That's how I read it.
They've had this language in here for at least 3 quarters, I want to say now. But Emmett, the FSD kind of software revenues do show up in automotive gross margin anyway, so it doesn't. I don't think it necessarily suggests that.
Well, they say hardware related profits. So like the profits related to building the cars is going to be, that's going to be lower, but it's going to be offset by an acceleration of the full self-driving uptake. So overall, the automotive gross margin, I think, is going to be, the operating margin is going to continue to be the best in the industry or something. I don't know. The way I interpret it is that hardware margins alone, I know it's included as a line item as automotive gross margin, but the actual cost cuts are expected to be offset by mostly software-based things, which is part of the automotive gross margins, as you said, Matt, when you talk about the full self-driving. That's the main software thing, is the full self-driving.
Yeah. Yep. No, it is.
And then the other thing too is with energy. So if I do the math on the margin for energy, it's down to 11% gross margin. So we actually saw a dip in gross margins for energy quarter over quarter. Just a heads up there.
Yeah,
I'm double checking my math, but I want to make.
And I would expect
energy,
that with ramping Lathrop, but yeah.
And I think energy was 9.4 in Q4 though, wasn't it? So that'd be a slight increase if I did my math right.
I had it at 12.1. I'm just taking the energy total revenue and then the energy cost. And so it's 16. Wait, do I have the wrong number plugged in here? Hang on a second. Oh, I have the wrong number plugged in. I'm sorry.
I can't trust your math today, Farzad. You've given off a couple times.
Can I ask a question? I know it's hypothetical, but is kind of the delta in, I don't know, revenue and then gross profit, if you plug in the 10,000 SNX in transit or 5,000, whatever number you want to pick, right? The number between produced and delivered of SNX, because they said they had a bunch in transit. I just wondering if that anomaly is a big chunk of this or not.
No, so that impacts cash flow, Jeff. So if you look at the statement of cash flows, like their operating cash flow was, I think it was $2.5 billion or something like that. So if you were to normalize out the cash flow impact, then that would raise the operating cash flow. But from the income statement, the earnings perspective, they don't recognize any costs on the what they spent to actually build those Model S and X that are in transit right now. So those.
I was referring to gross margins.
Well, gross margin is part of the income statement, so that doesn't hit the income statement at all. So the cost of goods sold doesn't.
No, but if it hit the income statement, like if those actually were delivered,
if it did,
yeah. I'm just wondering if we take them at their word and they were in transit, they have a home, they're just going to a new launch. I don't know, I'm just curious, but we can analyze that offline. But it's just a large number of SNX to be, in transit. So it's unique.
Yeah, I mean,
Stocks,
doing some
down.
quick math.
Yeah.
If it was, 10,000 units at a average gross margin of, 20,000, then you'd be talking about 200 million of incremental gross profit. So that would help a little bit, but, I'm not keen to take their word for it necessarily that those all have a home, given Model X inventories and what you can see.
Mm-hmm.
Matt, real quick on the energy margin, I just want to make sure I'm doing my math right, because I can't get to the 9%. If you pull up page 23, babe, on the deck, I'm taking energy generation and storage revenues from Q4 2022, and I'm putting it against the energy generation and storage cost of revenues below. So 1310 minus 1151 divided by 1310 gives me a margin of 12.1. What am I missing?
Okay. No, you're right. Yeah, I was kind of going off memory. So
okay. So never trust you ever again. That's what you're telling me.
I'm criticizing you for your bad math.
Yeah, thank you.
I don't have the facts either.
But I am seeing a slight decrease in margin quarter over quarter, because I know there was a lot of speculation and trying to understand when these sort of mega pack crazy margins would kick in, and it looks like, at least for this quarter as they're ramping, we're still not seeing that. even though revenues are up on energy 16% quarter over quarter, 17% quarter over quarter. So we're
Yeah,
still not
but
seeing
you know what's kind of interesting. So how much were those revenues up quarter over quarter, Farzan? Can you repeat that?
16%.
16%. But then if you look at their actual deployments on page 6, let me do the math here.
Let's go to page 6 real quick.
So their deployments of stationary storage are up 58%. So the 3889 over the 2462. So this is where you get into revenue recognition issues. They've deployed that much storage, but it's not like you just multiply that number by the price per megawatt hour and you get the revenue, because a lot of these are on like a contractual basis. So, you know, they've delivered the final portion to be recognized of that full, you know, 3.9 gigawatt hours that they call out here. But the kind of quarter over quarter incremental revenue recognition is not as clean cut as that. So that may actually bode well for future energy margins as they're able to, you know, kind of recognize incremental portions of that. But it's just kind of an interesting thing where you can't scale the deployments necessarily to get an indication of the revenue, because otherwise energy revenue would have increased 57% sequentially rather than 16 or whatever you said it was.
I'm muted. Sorry, guys. Anything else that people have discovered thus far as they're reading through the report?
Oh,
go ahead, Herbert.
Yeah. What do you guys think about the revenues at 24 billion? Right, that it was what their people were targeting, wasn't it?
Revenues.
And then is there a way to? I guess we can't see it from these guys, but the mix of Ys.
They don't break it out by 3 and Y. So here's what's interesting is that I would have. So this is, I think, again, talks to sort of one of the comments. I can't remember who it was, but a lot of these sort of raw material decreases, a lot of these expected, I guess, you know, from my end is like, okay, at some point we got to start seeing a significant decrease in raw material costs. And it looks like, at least in Q1, and, you know, we should wait for the guidance from the team as well, but you know, you have a 500 basis point decrease quarter over quarter, roughly, on margin on price decreases that were, you know, 10, 15% in the maximum. And a lot of that, I think, so that was applied mostly to Model 3 and Model Y, because that's most of the company's mix, especially the Model Y. So we are definitely seeing a lot of absorption from a cost perspective, because we did see the COGS come down 4%, or what was it, 4% quarter over quarter, if I remember correctly. But we're still not seeing what potentially could be more savings until later in the pipeline. But with the price decreases that just happened today, I think the whole sort of theory around ripping off the Band-Aid and then continuing to sort of let investors know, hey, we got it to this, but maybe we were wrong. So I'm wondering, like, if maybe, like, the guidance that Zach gave in Q4, I'm just curious if that's actually going to come to fruition now, right? And so I'm curious how everybody else feels about that. Well, how does everybody else feel? Like gut wise, how does everybody else feel?
Roughly in line with what I was expecting, I guess. I mean, I think the stock's probably down because the most important metric that everyone was looking at is, you know, what's automotive gross margin X credits, and it was not 20%. You know, so that's like the most significant, you know, bad news, I think, in here. But, you know, generally speaking, I'm looking at like their tax rate and some other areas which have historically been a sign of kind of weak earnings, and they all seem reasonably good. Like services margins were better than I was expecting. They mentioned strong residual value on the used car sales that is helping that part of the business. So, I mean, overall, it seems like a pretty strong earnings report from what I can tell, all things considered. Not amazing, but not a disaster by any stretch.
Can I ask this question, which is interesting? Might have answered my first question, which is why, when they announced the price cuts last night, but then they released this today, can I read this assuming that they knew this? So that when they give you a guidance that they still believe they're going to hit 1.8 million cars next year, 50% CAGR is still the same thing that they've been saying, but they've making that's now in an environment of continued price cuts. So does that include the current price cut that happened last night?
Yeah.
And if it does, that's good news, right? Because the guidance says to us that they still think they're going to hit what they've been saying they're going to hit. Auto gross margin didn't hit 20%. How big of a deal is it from 20% to something like 18 something, right?
Yeah. I mean, I think long term, there is a good, obviously, like long term, none of this really matters.
Yeah, it's
to be
silly.
completely honest, right? We're trying to sort of sit down and digest how this is going to impact short term, which is an impossible thing to do. But I think if there's one point of criticism that I do have is like, the guidance that was given in Q4 around those metrics, even though for somebody like me, I much more care about pricing being as low as possible so that every single person can buy Tesla. So this thing can be a behemoth in the long term. It's still kind of like, okay, well, you told us this number, it wasn't this number, right? So then what else? What else is going to happen here? So it's yet another thing, I think, for if folks are thinking about the short term, that might be a little bit of a way down in the stock. But I mean, that's up for interpretation. That's just my feeling. I don't know if people feel different way.
My feeling is this confirm, like in the macro environment we're in with interest rates so high, and if they stay high for a long time, as the Fed keeps jawboning, then equity valuations are not coming back to what we knew them as once, and in this case, anytime soon. In this case, Tesla's valuation might get compressed significantly. It's still going to be way higher than it was, 5 years ago, but it's going to be a lot lower than it is now. So Tesla's valuation may turn out to be 250 or 300 billion market cap if it's got 10 or 15% automotive gross margins until FSD becomes widespread and widely accepted, which could be years still. We don't really know. So that's my concern. And all the people who've been jumped on the Tesla bandwagon in the last, 2 or 3 years, they've been buying it at historic high prices where the stock gets lower and lower. I mean, it's not a good feeling for especially those people. And it's tough. I mean, a lot of us have been in Tesla for a long time, so we're okay with it going down another 50% from here. But, it's hard for people who bought when the market cap was $1 trillion to accept it's only, a quarter of what they bought it at and have to hold it for another few years to get back to where they were when they first bought it, so that's my concern. It's just going to be a little strange to see this happen.
Yeah. From my perspective, I think none of this should be a surprise to anybody. I mean, Elon told us on that Twitter Spaces, however long ago it was, that they will keep dropping prices to sell cars, and that is what's happening here. I would expect more prices to drop. I mean, I think Herbert, we talked about this a couple weeks ago, so I expect margins to come down. And to me, I see that as bullish. I know we're kind of getting lost in the weeds here. Looking at the quarterly earnings, and it's a lot of it's short-term perspective, but zoom out, open that aperture. We just got so lost into the numbers there. There's so many cool things in this report that we haven't even looked at. Some of the pictures, I think it's interesting. The Shanghai thing that they're talking about there, it sounds like maybe they're trying to de-risk a little bit geopolitically there. I thought that was interesting. But it's a bigger picture. I agree with what you're saying, Chili.
Thanks. Yeah, it's just going to be, I feel bad for all the people that are going to feel a lot of pain not understanding the bigger picture and just seeing their brokerage account go down and down, when they bought Tesla at the highs with all, with how popular it became in 2020 and 2021.
Well, let's talk Q2 now. So if you saw this 18 something auto gross margin today with the price cuts that they've been doing twice in this quarter, then they did one last night. Are you guys expecting that gross margin could actually be lower than 18% in Q2?
Yeah, I think for sure.
I think it's bullish.
But
it's bullish.
Let's bring Jeff in.
I really do.
Earlier in the call,
think about it. The more you drop prices, the more you create this. I mean, this is their moat, is their ability to actually finally leverage their sophistication when it comes to manufacturing. Up to this point, we've seen it come into the balance sheet, but now they're going on the offensive.
It's bullish for the business, but is it bullish for the stock?
Right. Let me go ahead. It's actually, can I just read this first paragraph here in the summary page, because I think it's a good primer for this topic. So this is from Tesla. In the current macroeconomic environment, we see this year as a unique opportunity for Tesla. As many car makers are working through challenges with the unit economics of their EV programs, we aim to leverage our position as a cost leader. We are focused on rapidly growing production, investments in autonomy and vehicle software, and remaining on track with our growth investments. Go ahead, Herb.
Yeah, no, that's great. So, I mean, what I was going to say was that everybody I talked to, almost everybody said that this is going to be Q1. It's going to be the lowest auto gross margin for the rest of the year. It's going to keep getting better because of all these, scaling that's happening. Now, reading that, basically, he was repeating what he said, right? Which is affordability is what matters. So he is going to, they're going to just sacrifice gross margin in lieu of sales and keeping going. So yeah, stock may not move at all this year, but strategically, this is very powerful this year.
Yeah.
I mean, it may not move at all, but it also could go down 50% is what I'm saying. But Jeff, do you think gross margins are this is the lowest we're going to see gross margins given the new price cuts and assuming there's going to be at least one more price cut to clear inventory at the end of this quarter too?
Yeah, I mean, using the coiled spring analogy, I always said, the first half of this year, that spring is going to be coiled and there's going to be some amount of compression. I'd still like to see the gross margin. I'd like to study this a little bit more than just being on this call to answer that. But I don't see this delta, between 18.3 to 20 is a miss. There's no question about it. It's just, I don't know if it's material at this point. So, I think we need to hear some. This is one of those things where you don't really sell on the kind of the ER report. You really have to hear their commentary, and then you take whatever you want to do with their commentary. You have to believe it at face value or not believe it at face value. If they give you some real quantifiable things on the call, like what's happening with freight, what's happening with various input commodities, then you may be able to take something to the bank. But I believe this first half, there's going to be a fair amount of compression. I don't know if this is the floor. I think it's pretty close to it, unless they do some more material price changes. But I think the second half, to answer the question fully, the second half is going to be about placing vehicles in the portfolio at purposeful unit economics that meet the needs of that portion of the portfolio versus taking existing models and just cranking them down further. Does that mean there's going to be zero price changes? No. But what I'm saying is they're going to fill out more of the portfolio by inserting new products like the Austin Model Y. By the way, the Austin Model Y isn't ramped at velocity. That factory is not running at full utilization. They don't have the right output yet in terms of velocity of that car through the factory. So that whole supply chain is not running at the gross margin structure it's designed to. So I believe as that gets to scale, that's going to well exceed the Fremont. When I say favorably, I mean favorably exceed the gross margin of the Fremont Model Y.
Yeah, let me go ahead and finish reading the statement from Tesla for those that are listening in, because it does give additional color to this discussion. I'm going to throw it over to the beautiful Alexandra Mertz. My goodness, stunning! Wow,
happy anniversary!
First we had Yashu looking.
Thank you, Emmett.
Happy anniversary.
25 years, right? 25 years.
Yeah, 25 years.
That's amazing.
Don't ask my age. Don't do it. Don't do it.
26 years. 26.
Wow.
Our near term.
I've got the longest.
Oh, nice, Herbert.
Yeah.
Nice. Our near-term pricing strategy considers a long-term view on per-vehicle profitability given the potential lifetime value of a Tesla vehicle through autonomy, supercharging, connectivity, and service. We expect that our product pricing will continue to evolve upwards or downwards, depending on a number of factors. Although we implemented price reductions on many vehicle models across regions in the first quarter, our operating margins reduced at a manageable rate. We expect ongoing cost reductions of our vehicles, including improved production efficiency at our newest factories and lower logistics costs, and remain focused on operating leverage as we scale. We are rapidly growing energy storage production capacity at our mega factory in Lathrop, and we recently announced a new mega factory in Shanghai. We're also continuing to execute on our product roadmap, including Cybertruck, our next generation vehicle platform, autonomy, and other AI-enabled products. Our balance sheet and net income enable us to continue to make these capital expenditures in line with our future growth. And in this environment, we believe it makes sense to push forward to ensure we lay a proper foundation for the best possible future. Alexandra, go ahead.
Yeah.
Thank you. It's actually funny because I pulled in once I'd read that page, because it gives me a lot of comfort. I don't like the numbers. Let's say that very straight forward. I'm not, hiding that I'm quite disappointed. I told yesterday on the Cyber Bulls that this was the quarter where I wasn't giving an estimation because I could not get myself to find a reasonable ASP, average selling price. We had this discussion with Jeff and Herbert and Christian yesterday. I wasn't going to just, take some estimations from the fourth quarter and knock it down, because it's so difficult to estimate when in which market they applied what reductions, that I think Troy's estimate was 46, and I said I'm not even sure it's going to be 46, and now it's by far below 45. So I think we overestimated average selling price, and they were really aggressive in applying those price cuts. And I mean, obviously not having details on how much Model S and Model X and Model 3 and why it is, we are always a little bit half blind when we announced. Second disappointment I have, and I'm sorry I'm saying it as it is the reduction on cost of goods sold is by far not as much as I'd hoped for. We've been discussing that with Jeff over months now. How long does it take to trigger through raw material cost and all the efficiencies of build? And we're not there yet. Well, the good news on that, the silver lining, is we're not there yet, but we'll be there soon. I mean, this is not going to take another 1 or 2 or 3 quarters. We're probably just there. Yesterday evening, when I saw the price cut, I really had belly aches. I didn't like the timing, because I mean, I sort of felt like, okay, either they're absolutely blowing it out and I'm completely wrong with my fears the last couple of weeks, and so they're so confident we may as well continue this way, or they knew these results were not as good as they should have been. I mean, obviously, we all know what happens. You have straight away the revenue cut, but you don't have the efficiencies yet. Operating margin at, 11.4, if I wrote it down correctly, is as well lower than we'd hoped for. It's obviously a consequence of what I just said earlier. Now, again, there's also good stuff in there, and one of them, Faza just read. The per vehicle profitability, they are seeing it over a lifespan. That is exactly what they should do, and us as well. And there's no point panicking now. This is gone. The last quarter is gone. It's autonomy, it's supercharging, it's services, it's connectivity, and all that will play out. They also clearly said they will continue with this floating pricing strategy. Yeah. I mean, I love this morning's Emmett's space. I mean, I didn't work much today. Thank you, Emmett, for keeping me off my day job. But I did like that we are starting to push a little bit for at least educational communication, right? You can't just expect. I mean, it's all good that there are 1 million, 2 million, 3 million people that are intelligent and understand how engineers talk. Well, I don't, right? I'm a woman. Thank heavens I'm married to an engineer, so he brought me 2 EVs. But there are millions of people out there that may have the money to buy a Tesla, but just don't get it and need to be educated. So this is probably a good moment to start this debate, and not just always, oh, Elon doesn't like advertising. Oh, didn't he say 5 years ago that he does like a little bit of advertising? What the heck, right? Let's just start getting the job done sooner or later. And no, I don't know better than management. They have much more numbers and data than us, but then prove it to us, right? And this quarter wasn't the proof for it. So they will continue floating prices, ups and downs, which is obviously new to an industry where buyers are used to go to their dealer and swallow whatever the dealer tells them the price is, right? Maybe negotiate or whatever. So Tesla doesn't have this bridge, and aren't we happy? We don't have to finance this bridge, but the raw data of pricing, just throwing it to the consumer, may not be enough, right? There may need to be some explanation. And it's all good to think how Elon thinks and how these nerds and engineers think, but there's also a consumer there that doesn't think the same way. Then the last point I want to make is operating cash flow. So the free cash flow that was added this quarter is 440 million. I mean, it's obviously a consequence from everything I just said, that is nothing. right? Remember all my nice tables with orange and green and Tesla being the best? This is the first time this is really a little bit of sand put there, but nothing solid. So this is gonna kill Gary's pipe dream of a stock buyback. They are not going to do that. They're not building enough cash at the moment to even consider stock buyback. I mean, I may be wrong in an hour, but I really don't see it coming. And the second thing is, this will probably deteriorate a little bit the outstanding financial position that Tesla had compared to all the other peers. I mean, we'll see. I'll do the table in 4 weeks, but this is by far not as solid as it has been.
Can I add
Excellent
a few?
analysis.
Please.
Thank
Okay.
you.
So yeah, thank you, Alexandra. I love, there are a lot of things you just said. Now, the couple points I want to point out here. One is, this is a unique opportunity for Tesla, that we aim to leverage our position as a cost leader, right? Number one. So they are purposely going to reduce the prices to the point that they are seen as the cost leader across the board. And I don't think it's just going to be against other electric vehicles, but actually ICE cars. And I've been saying this recently, where imagine the moment, which we're almost there, that everybody in the world understands that a Tesla is actually cheaper, the price, not only price parity, but actually cheaper than other alternatives, with or without the incentive. So I think that's why they're going to keep cutting prices. But they also say later, they say that, this is a near-term pricing strategy, right? Long-term view, as we just talked about. And we expect the product pricing to evolve upwards or downwards. So this is variable pricing. So I know that, Emmett, you were saying, what's going to happen if they continue to keep cutting prices forever? Well, they're not going to. At any moment, they're going to just say there's another 2,000. It's variable pricing. So I think that there's this cut until they hit this moment when they're at price parity. And then from there, they might cut some more, they might raise some more, depending on the scenario. And so
that's all fine. And I think the business is very healthy. I'm not arguing the business decision of it. The stock valuation is going to reflect very poorly. That's what I'm saying. And all the people who bought Tesla in the last 2 years at $1 trillion market cap, those people hold on to their britches. They're going to have to hold for a lot longer to get their money.
How long do you think? How long do you think?
Until full self-driving comes to fruition, or until Cybertruck is fully ramped? And
what about if there is a pivot, macroeconomic pivot?
Right.
Yeah. Oh, yeah. If also the macro market could save Tesla valuation substantially as well, but I wouldn't count on that given what's going on. Like, it seems like the Fed, there's a good chance they're going to hold rates high throughout this whole year. So I'm just saying, throughout this whole year, if margins are coming down, Tesla's stock valuation is a very good chance gets cut in half.
And I agree with you, Emmett. I mean, I completely understand that the Tesla buyer is delighted, right? I mean, and actually, I'm not even sure if it's easily delighted, because if you're currently wanting to buy, so what do you do now? Think, okay, they may go lower in 2 months again, and 3 months, so you hold off, and you have to now suddenly, accept that your car has a floating price and whatever. But anyway, it is obviously better to buy it now than to buy a Tesla 6 months ago. But for the stockholder, in the immediate, this is really not good. And I don't want to, whitewash it. I see all the comments screaming on me there. It doesn't matter. But it is really, I mean, Tesla has been known that they don't care about the immediate stockholder interest. And I completely accept that. I know that, as a stockholder, you better do know that. Yeah. But this is another of those proofs, and it may prove perfectly right in the medium and long term, but in the short term, the stockholders are gonna suffer. There's no doubt about it either.
Yeah, it's very reminiscent to me. Like if I think back to sort of where we were back in 2018-ish, 2019-ish, sort of being invested in Tesla. The Model 3 is ramping. The Model Y is being unveiled and being prepared to be launched. And there was like a lot of doubt around, this is just not going to come to fruition, or there was a huge difference between being a Tesla stock investor and then seeing the company sort of laying the foundation for the future. And I think it's between then and say about a year ago, almost, it feels like, since probably longer, since Tesla hit its peak, it seemed like the stock finally realized a lot of that potential that was discussed during that time. And now we're back in that arena where the company's still moving forward and is still making a lot of adjustments, but there is a sort of there's a different tone between the company and the stock, just like there was before in 2019. And it might take some time for that to come to fruition. So I just think from like a psychological perspective, it just reminds me a lot of that time.
I agree with you, and I'd hope that energy was actually pulling in, and that's my question to Matt. Didn't you expect more, both on the revenue and the cost side on the energy business?
No, so it was actually pretty close to my forecast. So I was forecasting, and as far as maybe if you could pull up the actual amount. So I was at 1.7 billion in revenue, and or was it?
You want the actuals from Tesla's report? Sorry.
Yeah. Yep. The actual energy. So,
producer Wef, can you pull up the slides and then we'll look at it together?
So I was at 1.7 billion in revenue, and then 262 million in margin. So pretty close to where they came in. I think on both metrics. I think they were slightly higher on revenue and maybe slightly lower on the margin. I think I assume the margin was a little bit too high, the gross margin percentage.
Page
but
24.
I mean, generally, this is pretty close to what I was expecting.
It was 1.5. It was 1.5 in revenues, and 1.36 in cost. Yeah. So I found it lower, but I mean, But one thing, while we're on the slide, sorry about that, Matt, I'll let you give you a thing. Do show us afterwards the Gigafactory picture on page 15, because that sort of made me happy after all that. There we go. So they're really there, right? I'm tooling it up. It's wonderful.
It looks a lot more sophisticated than the previous photos they've showed us, where it was a lot of like empty space. You know, Bradford's done some really good work on the ramping that they've got going on there. But Alexandra, before you joined, we were talking about how if you look at the revenue growth, it actually wasn't that impressive. Like we were saying, I think it was like 18% or somewhere in that neighborhood, sequentially. But 57-ish% if you look at the deployments of Megapacks. So there is this issue of the revenue recognition on the deployments, you know, lagging a little bit, and it's not going to be a kind of like one for one, you know, increase in revenue as you know, both the Lathrop plant ramps up and the deployments ramp too. So this is going to be kind of a slow burn. I think it's going to be a little bit lumpier than we might expect. But it's like, to me, the general trend is exactly what I wanted to see. I mean, it was not like the crazy zero-sum game thing of like, we're going to do 10 gigawatt hours this quarter and it's going to be like $1 billion of gross margin or whatever the crazy things they were saying. You know, it's just a solid kind of build. And the thing that I hope they really emphasize right now is like, this is becoming a credible business. Like, yeah, it's still small. You can still ignore it at this scale, but they've got 80 gigawatt hours announced. You can't ignore that if you're a Wall Street analyst anymore.
And how do you make the margin out of that? Because I came to a margin, I wrote it down somewhere, 38 or 39% on the energy. No, but once you integrate what's already deployed, can you get something out of that?
How do you make money on the stuff that's already deployed? Is that the
question? No. Can you extrapolate the real margin? Because obviously the 11% is not the real margin because it doesn't have everything in it yet.
You're saying once you recognize the deferred revenue.
Exactly.
Oh. You know, I think part of the issue with the margins is that you're going through the backlog, which was priced at a lower you know, dollar per kilowatt hour. So you know, I think more of the upside is going to be just like in churning through, you know, that lower priced, frankly, lower margin stuff, because, you know, you still didn't have the lithium pass through provisions in the older contracts. So I'd imagine we're getting pretty close to the end of those contracts, and probably getting on to, you know, more of the higher margin ones going forward. So that'll be a really nice kind of compounding effect to have more deployments, but also at a higher price.
Okay, thank you.
Can I ask Emmett again about the stock price again? I have this thought that you guys triggered. At the beginning of this call, you guys were saying, you know, one of the things the theme is, let's pull the Band-Aid off, you know, right? Like hit them hard. And then you were saying, Emmett, that the stock price is probably not going to, it may even fall. It's going to be flat for the rest of the year. But isn't it true that the big reason is because of the macro, because of the interest rate until they pivot, which is a year later. So strategically, even let's say that Tesla does not lower the sales price, the prices of their cars, and they have amazing margins, and they sell still maybe a little bit less volume, but it's in a macro. So it almost doesn't matter what Tesla does this year. They can announce a Shanghai Gigafactory, Shanghai Megapack factory. They can show movement in the Megapack business, the energy business. Not going to do anything to stock price this year because of the macro. It's a growth stock. It's a story stock. But then once that flips, then everything changes. So, you know what I mean? Like maybe this is the year to go ahead and, sell volume, lower the margins because of the macro anyways. What do you think that there's something to that?
I think the macro market is, the overwhelming tide of valuations of stocks, growth stocks, especially, and Tesla is considered, in that bucket. I think that margins being compressed puts it even more in the category of a growth stock that's not as profitable or not likely to become as profitable as soon as previously was expected. And so if they did not compress margins and margins stayed at 25% or 30% like it was several quarters ago, imagine, then I think the stock could be close to $1 trillion market cap right now if it was at 30% right now. So I think margins are a big part of the valuation of Tesla, and 15% margins versus 30% margins is huge on the valuation.
Yeah, and exactly. And we're on a PE of 50, right? I mean, I also, I was chuckling when they said, "Oh, we're still industry leading with car margins." Well, of course you are. I mean, I hope so. I mean, if suddenly we're comparing ourselves to the GMs and the Fords with all their antiques and everything, I mean, that's not a place I even want to think going. No. So, and I don't think Tesla does. Let's make it very clear. But I mean, with a 50 multiplier of your PE, there is an expectation to growth. And it's not only an expectation of growth in number of cars, it's an expectation of growth in the stock price based on extended margins and not a reduction to an 11% operating margin. That's just it. It's not, I mean, is 11% operating margin good? Yes, of course, it's absolutely correct. But we're comparing ourselves now suddenly to quarters like Q2 2022 when China was closed for a couple of weeks, right? We're back into problematic quarters, which happen all the time, and then next quarter is better. And I'm by far not, giving up on Tesla, not at all. But I just want to also be realistic about where we are at the moment and what work has to be done.
Real quick, I want to bring up a tweet. Just this broke about 50 minutes ago. I just want to get everybody up to speed. News: Microsoft drops Twitter from its advertising platform as they refuse to pay Twitter's API fees 52 minutes ago. And then Elon responded, they trained illegally using Twitter data, lawsuit time. So just give you guys a heads up that it looks like Elon's going to sue
the AI wars.
So
yeah.
That should be fun. Okay. Just real quick. Go ahead, Nick.
Yeah, quick question, because I think you can tie that lawsuit back to the way I'm thinking about what they're doing. But I'm curious, why do you guys think they're dropping prices so aggressively if it's not for demand or besides demand issues? Like, do you guys have your own thesis or, ideas of why?
Demand, pure demand. It's simple. They need to ship all the product they build, and they refuse to educate the public and instead are dropping prices.
But
yeah, I don't agree with that.
Okay, what do you think?
Yeah, I said it earlier, right? I think that the reason why they're reducing prices that they want to get to a point where it's a price parity with gas cars. There's an important no amount of advertising is going to change costs, and cost is still the number one reason why people don't buy EVs. Until you get to the cost level, go ahead and advertise. And I'm not against advertising. I want them to advertise. I'm saying that too. I'm just saying that right now, cost reduction, it hits margins. And then I'm saying, well, even with a macro environment the way it is, you can have I got to weigh a little bit of what you're saying, right? Maybe, but margins, you discount cash flow over multiple years, and so you're going to compress and all that. But you're not going to be a growth company during a macro, anyways. And so,
okay, yeah. No, that makes
I
sense.
do
Yeah.
believe I do believe there is a plan behind it. It looks like as if they have a sort of a system in place where as soon as a certain number of orders per day in a certain market drops to this level, then comes this action. I don't, last night when I was looking for some comfort zone, why they would do that in the evening of the earnings, I thought I told myself maybe it's completely dissociated. Maybe there was just, yesterday sales numbers came in, it dropped to a certain level, and that triggered the next price cut. The other hypothesis is that they obviously know to the cent their cost pricings, right? How much cost they have. And so I do believe they have a sort of a corridor. When they see they can now suddenly produce the Y at this cost from this week onwards, well, then they adopt the selling price. The end goal obviously is have as many Teslas in the roads as possible, which are a vector for so much more income afterwards, right? Autonomy, services and all that.
Amy showed an incredible graph that showed that Tesla's pricing is pegged to the average sales price of the cars in the US. And so the Model 3 is, I can't remember exactly, it's like one times, and then the Model Y is 2 times the average sales price. And so when you see the sales price go down, they lower the price. And when it goes up, it goes up. So it's a matter of pegging it to that.
Gotcha. Yeah. So the reason I asked is because I have 2 thoughts on this, and maybe I have a different background than I guess all you guys. So maybe that's creating this inherent bias in my mind. But when I see what they're doing here, and I see Elon talking about, suing Microsoft right now, it just screams to me just that this is all about data. That's all this is about, right? I mean, everything you guys are saying obviously is right as well, right? There's elements to it, but I think from their perspective, it's one with the EV tax credit and all that. This is the moment to really, who cares about costs? Get the client base, dominate the client base, just like iPhone. Once you're on an iPhone, odds are you're never going to leave, right? You build that ecosystem. But then the other part, we are in the data wars now, right? It used to be where people didn't know what to do with all this data that they mined and they didn't know how to clean it. They didn't know how to label it. But now we're in a different paradigm. And I think Tesla is trying to say, who cares at this? I mean, they care. They have a business to run, but what they care about is getting as much data as possible. And every car they sell, right, it's the same way. They're losing money on the hardware for FSD and all that, but they're getting more and more data. And I mean, I think you're starting to see the results of that with the beta releases. So to me, that's the bigger thing, right? And we're going to live in this world now where everyone's protecting their data. You're not going to, I don't think you'll see a lot of ChatGPT type things crawling the internet, getting all this just data. People are just going to hoard it now. People are going to not allow you to, scrape their environments. And so to me, that's what I see. But I have a different background, so I don't know how biased I am. But do you guys agree with any of that, or think that's part of it?
No, I think it's part of it. I think it also ties in with the auto emission, the number of units. They made these capacity decisions a year ago. They said we're going to have a run rate coming out of our factories of 42K a week. In the second quarter of the year, 42 to 45K, and they'll just continue scaling. And as they continue to scale, they're going to say, okay, what do I need to sell vehicles at to keep my utilization in my factories and my supply base up, over that 80% number. And if they can do that, they weather through this recessionary period, because the thing that kills companies is when your utilization drops and then you're screwed because you have all these fixed costs and your whole cost structure caves in. So I believe the mission is get as many vehicles out as possible. Also, obviously, run a very profitable business so you can do that and build more factories. And then there is going to be a tie into the data piece because they believe those two are going to marry together. But I think the way investors are thinking, there's a near term of it was 20% and they reported 18.3, put a gun to our head. And then there's people thinking what's going to happen the remainder of this year? Well, we have to see how they actually, this is where I think where the conference call is really important in terms of where they see the rest of the year. Are they going to cut every month? And where one of my questions is in the top 10 of the say questions, which was, do you see your COGS reductions catching up with MSRP deflation, and when? So I think they need to weigh in on that. But I do think all this does tie in together, and there is a war in terms of data, but I believe Tesla is well ahead of that with what they're doing with FSD.
So just a couple points here. One is the reason why they're suing Microsoft is Microsoft essentially controls OpenAI, and there's a fight against that right now. And then two, FSD is you saw that statement about total cost of ownership, and the question is how long do you think it will take for FSD to come? And what I'm hoping for, and this is just a total hope on my side, don't hold me to this, but you see how we all thought that general AI or the company to be able to beat the Turing test might take 5-10 years from now, and all of a sudden it happened within 3 months. The entire world within a month freaked out at how incredible GPT is. Could that also happen with robotaxi?
No, Herbert, it can't. It can't because the car has no. It can't. I mean, I wish I could, but we're having this discussion often enough to interrupt you in the middle of it. With the car, there's life at the other side, right? You can't. ChatGPT, you could turn it off and turn it on, and that was it. And there was no risk to it.
No, I'm not saying that robotaxi. It doesn't have to be robotaxi is approved. It's just that robotaxi FSD beta being driven by a human is so amazing all of a sudden that everybody goes, oh my God, this is it. It works. Let's go ahead and get all the approval.
Only
that's what I'm saying.
Enough people have the cars. You need to drop the cost structure for the cars so they can have accessibility to it. Whereas ChatGPT, anybody can just jump onto and to a domain.
No, I'm just saying that when somebody starts seeing the videos of this car, all of a sudden being able to drive so much better than another step change up, that moment could happen. Oh, robotaxi's here.
100% agree. 100% agree.
Matt, what are your thoughts about Nick's question before about demand and price cuts that Herbert and I disagreed on? I mean, how do you square away the price cuts in relation to demand or not in relation to demand? What are your thoughts? What do you think?
Yeah, I mean, Elon did kind of, share his thoughts pretty bluntly. I mean, he basically said he'd erode margins to zero if that's what it took to get more cars out there. Which was really alarming for me to hear. He's so convinced that like FSD is going to change everything, so the short-term results don't matter. And he may very well be right, but that's not really optimizing. I think the performance of the company, in the medium term. So yeah, I'm concerned that we've kind of spoke ad nauseum about the fact that they're not doing marketing, so I won't kind of beat that dead horse. But I mean, it just seems abundantly clear that demand is not where Tesla hoped or thought it would be. And we've talked a lot about, like Elon was saying, I want to put this issue to bed once and for all. That was 3 months ago. How many price cuts have we seen since then? So no, Elon, you didn't put this issue to bed once and for all. Like, this is still very much on the table, and no matter like how much you talk about like autonomy coming and like where things are going to be fine, like that doesn't assuage people who are looking at the current data and saying, no, it looks like you actually do have a little bit of a demand problem.
But I think what's interesting there, and Dave Lee mentioned this on your space earlier today, which was a fascinating point, is that how Elon defines demand is different from how most people in the actual definition of demand, right? Where I think he's, if I try to not botch what Dave said, he said something along the lines of, Elon thinks of demand as the total potential buyers at any given price point, versus how demand is defined actually is based on how many customers you have for one given price point, right? So, and I think that is where a lot of maybe there's a dissonance there on how it's almost like Elon is using a word. He's kind of redefining what he wants it to mean, and then he kind of says it, right? And I'm not saying it's right or wrong, but I just want to make that point because there just might be it's almost like a language barrier there, right? It's not, I'm saying because of English, it's because there's just a different definition to it. And maybe that's why there's a little bit of a confusion around it, right? I just want to throw that out there. Sorry, Matt. I didn't mean to interrupt you.
No, I thought that was a great point that Dave made on that Spaces, which was really phenomenal. It's kind of interesting as I think we all have very different views on like the right kind of short-term optimization strategy for the company to weather the next 12, 18 months, and who knows where macro is going. But like in the long term, I get the sense that we're all like incredibly optimistic about where the company goes on the other side of whatever this macro situation.
I just don't know how any other automaker survives. Like it becomes more and more of a thing where it's like it's insane. If you bring up page 24 real quick, producer wife, we've staged this because I think this is the first time I've ever seen this graphic displayed. So, oh my God, not page 24.
Oh
page
yeah, that's
21.
my jam right there. Look at those numbers.
Page 21. Calm down, bro. Let's keep it PG. So this is key metrics trailing 12 months. So for those that might be having a tough time reading this, so this is on the left chart is from Q1 2019 to Q1 2023. So basically for the last 4 years. The red line is Tesla's year-over-year quarterly growth. Basically, so Q1 is going to be the growth versus the previous year Q1. And then the blue line is all of the S&P 500, which is basically one of the indexes that Tesla is a part of, all the bunch of different, it's basically the 500 most valuable stocks-ish in the United States, or not in the United States, in the United States, right? S&P 500 is only US companies, right? I just want to make sure I'm right there. I believe that's right. Is that right?
Yeah, I think so.
Yeah. And then the gray line is the auto industry. So they've separated out the auto industry and kind of displaying it and saying, hey, look at the auto industry. See how they're growing from a revenue perspective quarter over quarter. Isn't this interesting? And then the one on the right, it's operating margin. So they've taken Tesla's operating margin percentage for that quarter. So for Q1 2023, it came in around 14%. Same thing for the S&P 500, which is a bunch of different companies. You have tech companies, you have automakers, you have manufacturers, you have all kinds of crazy stuff. And then they've also shown the auto industry as well, kind of staying really flat since the beginnings of COVID-ish. And so I thought this was fascinating because it looks like Tesla is really starting to around this sort of topic that we were discussing slightly, is that they're starting to say, hey guys, yeah, pricing might be going down, margins might be going down, but check this out. Look at how much better we're performing versus everybody else on the whole. And I don't know if they've ever shown something like this before on their deck, and I just found that to be fascinating.
They did, and you don't have the Q1 numbers yet for the S&P and for the rest of the industry, which may as well go down as well. So you're 1 quarter ahead for the Tesla red line.
Okay.
I looked at that negatively, thinking that they just use that as a crutch to like hide the issue.
Okay. Fair enough.
Yeah, I mean, when I saw this, I just go ahead.
No, well, I was just gonna say, like, if you're GM or Ford, like, this is horrifying. Like, Tesla's doing all these price cuts, and you've got like a 7.5% operating margin, and Tesla's dropping prices by 7%. Like, how? It's just that's why, like, I don't really care so much about what happens in the near term, because when we get out of this, like, they're going to be in such a prime position. It's just ridiculous. But go ahead, Nick.
What's your reaction when you heard him say it's not about price cuts? It's not about they're not trying to kill Ford. They're not trying to kill these guys. They're just trying to get an affordable car out there. But then that is what's going to happen, and that's not his intent, right? Unless he thinks he's going to license his technology and factories to these guys. Maybe there might be a partnership soon.
It's it's a good thing, right? I mean, you're essentially, it's like what happens in any industry with new technology. It's the same thing, right? Like, eventually you're going to get priced out or you're going to get forced out of the market if you can't innovate fast enough. So them dropping, it's going to force them. They're not going to, I think Farzad or someone said it recently in like the last 2 days, people are going to be forced to innovate or die, right? They're not going to have a choice here, right? It's inevitable. And so it's one or the other. I mean, again, some people will survive here and there with ICE, I guess, but these big, large auto manufacturers like Toyota, like Honda, Ford, etc., they're not gonna have a choice. And every time Tesla drops the price, it's forcing them to either accelerate what they're doing or to die. It's one or the other. And I agree with Farzad on all those.
Okay, so I think the say.com questions have been updated. We have to get Matt to answer as if he's Elon, because Matt knows Elon pretty well.
Yes. Here we go.
The last time he did it, it had an English accent, then it had a Scottish accent.
No, he had a good South African accent, I'd say. So
he's been practicing, I think.
So
and you got to dance.
All right, here we go. This is the. I think
should we preface this a little bit about what this is?
Let's give some context here, right?
Okay,
so that Say is a website. So go ahead and pull it up, producer wife. Say is a you don't want to leave, by the way. Welcome all 4,200 viewers for this incredible impression. Not to make Matt any more nervous. So pull up Say. So Say is a website where investors can drop their questions for a bunch of different companies, and these are the most voted on questions for Tesla for the Q1 earnings call, which we'll cover live here in about 25 minutes, and we'll also do notes live as well for those that would be able to use that. And what we're going to do now is Emmett is going to act as if he is a person asking a question, and then Matt Smith is going to be Mr. Elon Musk answering the question in his best South African accent. I can't wait to hear this. Go ahead.
Train wreck of an accent. I apologize ahead of time.
James F. asks, what is the process to make auto pricing adjustments? What variables do you consider, and how frequently do you review pricing? Elon?
What is the process? Yeah, well, if we need to sell more cars, then we adjust the price. Yeah, the process is we try to sell the cars, and if we need to lower the price, we lower the price. If we need to raise the price because the backlog's too long, we raise the price. So yeah, that's our process. It's really not that complicated. I think anyone in Econ 101 could figure out how to do this.
But what about the last part, Elon? How frequently do you review pricing?
Look, we have just amazing amounts of data, granular data, just well beyond what any of our competitors have. So we're getting this on a real-time, minute-by-minute, geographically specific location, and so we're optimizing all of those data points in real time. When we if someone thinks they've got better data than us around pricing or better suggestions, I'm open to hear it, because we want to be less wrong over time. But yeah, we're constantly looking at this, and yeah, if you think you can do something better, then please join the team.
And Elon, while we have you for the pre-earnings call, Jeffrey L asks, do you still believe Tesla Energy will be bigger than auto, and when will you provide more formal guidance on Megapack and the overall Tesla Energy?
That was me, by the way.
Oh, that was you. I thought you said that was mean. I was like, my impression was mean.
Oh, no, that was Jeff.
No, that was me. That's my question.
Forgetting the question. All right. So slipping back into character here.
Okay.
Look, if you think in the limit around the size of the energy opportunity relative to the size of the automotive industry, it's very clear that the energy needs will be much larger than the automotive needs over time, and especially once autonomy is solved, the price is essentially going to trend towards zero on the marginal cost of a mile driven. So energy over time will certainly become much larger. So yeah, it may take some time because ramps are slow, and the automotive will be ramping quite aggressively, and it's got about an order of magnitude difference in the size of the businesses right now. So for the time for energy to surpass automotive, it would be at some point in the next decade or so, probably mid to 2035. But from there, the opportunities will just be much more significant on that side of the business. And if you read Master Plan Part 3, I mean, it's not. People think it's all about like solar or batteries, but it's the entire economy. It's home HVAC, it's industrial processes, it's hydrogen, and so these are things that we're just starting the transformation of right now, and it's going to be massive, and people underrate it.
Right, Elon, we're going to go all the way down to a question. I'm going to pick one. Oh, look, Emmett P asks, with 128 votes, 216,000 shares, way down there, he asks, has Tesla considered testing traditional TV educational advertisements targeting the general public, not on Twitter? Testing it may show this as a more optimal way to increase demand drastically at current price levels versus relying primarily on price cuts.
Yeah, well, I don't know what to say. If people can't afford the cars, then they're not going to buy it, even if you have a really slick advertising campaign. So, yeah, spend money so that people who already can't afford to buy the car now want to buy the car even more. Yeah, good. I think that's a really good idea. Maybe we should try that out. Or maybe you can just trust us who have the data and let us do the job. I would maybe suggest that. But good question, Emmett P.
See, Emmett, why is your question so far down? Why did most
we
people
can't even
not
pull
vote
up
it
your
up?
question, bro. My
It's so
God.
far down. Yeah.
You know,
so Matt's gotta do this every time, right?
Yeah.
Every quarter.
Yeah.
Yeah.
You got a little
Yeah.
sneak peek, everybody. Dude, like the little mannerisms in between were like the look, like that was just incredible. I just want to, it's like you got in front of a mirror and practice. How long did you practice for this? I'm just curious. Did you actually
practice either for our thing yesterday or today?
That's amazing.
I'm listening to Elon. I don't know.
Yeah.
Maybe I should do a Tom Jew. I'll be Tom Jew next time.
Yeah, you did a great Zach Kirkhorn one. Maybe we should ask a Zach Kirkhorn question of you. Anyone find? Okay, well, here we go. Zach Kirkhorn, this is going to be directed to you. What do you anticipate fiscal year 2023 automotive gross margins ex credits will be at the company's current pricing levels?
Yeah, so we're not going to provide specific guidance on that metric at this time. I would just say we expect them to be strong. We've guided that our operating margins are going to be industry leading, and when we stand by that, we're not going to share specific projections, but what we think our own internal models are showing really strong, profitability. We think we'll continue to be industry leading. So without providing specific guidance, I can just share that we think we'll be self-funding. We don't need any future capital raises, but we're gonna do everything that we can to really improve our financial performance. And I think when we get on the other side of this, you're gonna start to really see the benefit of some of our ramping on energy and services margins are really increasing. So I wouldn't get too caught up in that right now, because our long-term financial performance is going to be quite strong.
If this isn't proof that Matt listens to every single word on every single earnings report, I don't know what isn't. So if you need trusted resource for information, Matt,
this is Matt GPT. Is what this is.
Matt GPT. Yes.
Oh, that was awesome.
Oh my God. Wow. Okay. So we do have the call coming up in roughly 18 minutes. Matt, thank you. That was incredible. That was actually legitimately hilarious.
I don't know how it came off as decent as it seemed like it did, because
it was
great.
This one's better than yesterday's. Beautiful.
I'd rather listen to you than the actual call. So we'll start with Herbert.
I can make the margins whatever I want too. So
Go for it.
Yeah. So let's go around the horn here before the call starts. We'll go Herbert and then we'll go clockwise around this screen here. So Herbert, what are you expecting from the call? What do you want to hear? What do you think they're going to say? And then we'll go around.
Yeah. Okay. Well, I am disappointed. So they're going to kind of couch around it, and they're going to say, this quarter is done. What matters is looking forward. We still expecting 1.8, maybe 2. We're still expecting 50% CAGR growth average over the years. We're doing strong as a company, and this is an opportunity. They're going to repeat what they said in the opportunity in the summary statement. So, I think that's what I'm expecting. I don't think they're going to say that the macro is impacted us, and that's why the auto gross margin is lower than it is. But yet, all of our scaling, all of our factories are on board. Everything's moving nicely. So, I think that's what they're going to say. I don't know if that's good enough. Is that enough to make sure the stock doesn't get crushed? But yeah,
Matt.
Yeah. So I kind of think I was thinking back to the Q4 call, and it was a similar kind of like dip on the release of the presentation, and then it actually rallied after the kind of guidance that they provided. So I'm hopeful that they kind of follow a similar path where they focus more on kind of longer term guidance and how they think that the margins might be sustainable even in the face of future price cuts. I hope they don't just BS us on demand, because I think the market is really not appreciative of that. So I would almost prefer Zach kind of handle that question rather than Elon, honestly. But I would say I'd really love them to talk about the energy side of the business a little bit more. That there's a question on Say, which I'm sure they'll get to on kind of like the ramp and where the margins can go. And so I'd love for them to kind of focus on that as a longer term upside that analysts need to start modeling in.
Looks like
Yeah, my thought would, if I would have to prepare that, I mean, obviously I'm never going to be in that position. I would prepare for a lot of details on energy here. First of all, we're all looking forward to that. We all want more food on that, and obviously in the financial, there are not more details in it than there were last quarter. So it would be great if they went into detail that from there. It also gives them the exposure, because today there will be lots of people listening to this call, because it's difficult to understand these numbers and their current politics. So I hope they're doing that they're going really into detail into energy, how they're ramping it, how the deferred revenues are going to be integrated, and how quickly they see this being a major profit center for the whole firm.
Jeff.
Yeah, I hope they get into the. I was just reading the earnings transcript from the last quarter's call, just around the $47,000 ASP and the 20% gross margins, and he said he didn't give a period of time. He said, "But we'll stay above 20 points, 20% gross margins." I don't know if that's over the year. Is it each quarter sequentially? Like we'll never fall below it. So I just be interested to see how they respond to the 18.3%, and what they kind of guide to moving forward. I would like to hear more. I would like them to actually formally break out energy in greater detail in terms of the forecast. So yeah, I'm looking for. I think this is one of those earnings calls where you really have to hear the guidance from them. I think if they formally come off the 20 points. First off, they say, look, a lot of pricing changes. We didn't know what was going on with the IRA in the quarter. A lot of things had to move back and forth. Customers were confused. By the way, the first pricing changes went in, basically in the third week of the quarter. And if you look at it over production weeks, that cuts out about 5 weeks of production volumes that would land to customers with the pricing changes. So it's something, it's meaningful. And there's also that first month, there was a lot of confusion about the IRA. So for me, I would like to understand, when they have a full quarter running at the price cuts, a full quarter with the IRA is in from day 1 to day 90, be interesting to see if they see any difference in order velocity, or if they can even comment on that.
Oh, I'm up.
Go ahead.
Yeah, I think we might see some interesting stuff. I think Elon might come out kind of in attack mode, to be honest. I think he might. I mean, just if he's tweeting this right before the earnings call about suing Microsoft, I could see him kind of being adamant about prices will keep coming down. We'll do what we need to do. That's about the mission, all this stuff, and I think that they'll make it very clear that autonomy is the future.
And Chili.
Yeah, I mean, Nick stole a couple of the points I was going to say. I think Elon's going to be asked about automotive gross margins, and maybe Zach will answer for him, but I think Elon will signal that we should be prepared for price flexibility or price changes to meet demand no matter what. Like he will sell the cars, if they have to at a loss, as he had mentioned on that Spaces. He might even mention that line if he does. I would be concerned for how institutional investors are going to interpret that in the coming days. So I think Elon is going to just lay the hammer down and say, hey, we're going to keep lowering prices if we need to. We're just shipping as much as we're building as many as we can. We're changing the world. Autonomy is going to turn all these cars into money-making machines any month now. He'll signal something like that any time now, and it'll be the largest asset increase in history, or whatever the term he uses for that. And I think he'll reference that maybe again to keep some of the bulls happy, but I think overall he's going to just, lay the hammer down about price cuts continuing.
Okay, we're about 10 minutes away from the earnings call. We'll be covering it live here as well. We'll be doing notes. I think from my standpoint, the attack mode comment is an interesting one, because it does seem like, I would be surprised if that's the case, because I do think there has been a lot of, if you kind of follow his interviews as of late, he does seem to be in a relatively good mood. He's been giving pretty, even with his conversation with the BBC and Tucker Carlson and those guys, he seems to be in a very lighthearted mood. He's joking around. I mean, he's working a ton, but it doesn't remind me of 2018, 2017 Elon, where, I mean, you could see it in his face. The dude was literally falling apart. I mean, the guy, I've never seen somebody look so tired before in my life. Whereas nowadays, he does seem a little bit more relaxed. So I do feel like from that standpoint, the tone of the call is probably going to be quite a bit more positive. I think they're going to reframe it around, hey guys, like, this is what we're doing. We can't, we're the only ones that can do this. And maybe if that's attack mode, it's attack mode. But this is what we're doing. Nobody else can do this. We have our eyes on the future. Energy's growing. You can see it. We still are making a ton of money on our cars. It's not, it's not 20% or above, but it's 18%. And we're a mass market vehicle maker. We're the only profitable EV maker out there by a long, long margin. We're taking market share away from competitors. And that's what we're going to continue to do. And, if they start teasing full self-driving more, great. But I think it's going to be one of those things that we're going to have to see actually come to fruition with my own two eyes. I'm seeing it come to fruition with my own two eyes, but on one data point out of 400,000, right? So I think there needs to be more proof in the pudding for that to actually take this story forward. So I think it's just going to be refocusing on the long term of the company, and and giving data points, hopefully, that continue to reassure investors that that's coming, and for folks to start worrying so much about the short term and focus on the long term. But it's the stock market. I don't know how realistic that is.
Yeah, I think the other big thing they'd have to answer to is just on the cash side. I think Alexander brought it up as well. I mean, it looks like if you take ZEV credits out, they're negative cash. So
exactly
so that's something I think they need to speak to in terms of, is there. So here's what I think is happening, and I think this we'll see a little bit more inventory buildup in Q2. I believe they're accumulating 4680s, battery cells, packs, and other components, not only for Mega Pack ramp, but also for Cybertruck is starting. So that's unfortunately, when you have a massive new product cycle, in this case, Mega Packs and Cybertrucks happening concurrently. One thing you do is you accumulate a lot of components until you get the peak run rate and output of your factory. So that's something to keep an eye on.
Yeah.
They doubled inventory.
Yeah, if you go to page 24 on the earnings report, producer wife. Inventory went from $12.8 billion to 14.3. So that's 1.5 billion.
And compared to next year, and compared to last year, same time.
And then last year, 6.6 billion. So if you can pull that up real quick, producer wife, on page 24, so folks can see it while my dogs go crazy. So the inventory line, which is the 1, 2, 3, fourth line down, it went from 12.8 to 14.3. So that's 1.5 billion in cash that's sitting in cars instead of the balance sheet.
Well, cars, batteries, anything.
Yeah, anything inventory related. Yeah,
and you look at the production pipe, comparing that point in time last year to now, I wouldn't be surprised with the net, because you have more delivery nodes and you have a wider production output node. If you look at their days of sales, by the way, if you go down to the bottom, it's, there's nothing jumping off the page in terms of DSO. So that actually says a lot in terms of them being able to keep up in terms of with sales velocity, with production velocity increasing.
So that's just to maybe explaining it to like the audience that might not be familiar with that audience. What it basically means that even though they have more inventory, they're selling more, and so the number of days it would take for them to clear that inventory is the same. They just because they have more doesn't mean that they have a longer backlog in a different way. Is that a proper way of summarizing that, Jeff?
Yeah, and there's some nuances. I mean, with days, DIO versus DOI, like there's, you have to understand the actual the cash value of the assets as well, which is what I think they're assuming here. But yeah, no, I think you described it well for the audience as far as it.
Perfect. Any other thoughts?
Yeah. So one of the things I've been hoping for is a moment when one of these quarterly earnings calls comes out and they finally make a really big push to change the narrative that we're not just an auto company, we're an energy company. Do you guys feel like there was enough now or not yet? Because they can talk about the Shanghai Megapack factory. They can talk about the Lathrop now almost pretty well. I think it said there that they're already at production and even could do more at peak. They can talk about the increase in margins and sales and the new sales that they've got lined up. It's still not quite enough though, right? Or is there enough there that maybe they can just say, hey, we missed on the auto gross margin. The macros affected that. Our goal is to do, mass volume sales. Irrespective of that, long-term value, lifetime value is what matters. But actually, what matters for us as a company is energy. Is that enough or not yet?
Well, I mean, cost still will matter. I think the best thing they could do is just go out, explain this is a difficult quarter, but if you have such an aggressive pricing politics, you need a couple of quarters to stabilize that. And obviously the first one is going to have the worst impact because you don't have your costs under control the same way yet. So you're in that scissor movement where it's the worst at the top. I think if you can really explain that 2023 is a transitionary year where prices have to become, like you say, cheaper than ICE cars and the evident choice of the regular consumer. So, but if that is their case, they need to lay it out better. They need to make it more understandable to the layman and not just us, hypothesizing over it.
I mean, to me, they could make the case really clearly just by saying, hey, we've announced 80 gigawatt hours of Megapack factories. That's roughly $40 billion in revenue. Now, it's going to take some time for us to build up to that. But what we're seeing in the marketplace is that there is ample demand for that. And actually, if you look at like the interconnection queues, like the demand industry wide is absolutely exploding right now. The IRA helps it, like yada, yada, yada. But say like, we think that that's a reasonable run rate in the next X number of years, and we're going to build from there. Like, I think they haven't done the math yet. Like, they put out the things so that people like us can do the math. But to me, that would be like a very simple thing for them to do to kind of shift the focus a little bit.
Can you guys hear a tiny bit of music in the background? Just want to make sure the audio works.
No.
You can't hear audio?
No.
Okay.
No.
All right, no problem. Sorry, I didn't mean to interrupt anybody.
I would just say one last thing too is for anyone who as a long-term investor, if you close your eyes and can fast forward to 10 years and open your eyes to see what the Tesla stock valuation is, you'd be supremely happy. No matter what happens the next 6 to 12 or 18 months, if the stock gets cut in half, whatever, just if you're a long-term investor, I think you just have to realize that, sometimes things take 5 or 10 years to play out. And so that's still the story, I think.
You're good. We'll hear
Okay,
it.
now you can hear it? Okay.
Yeah.
Perfect.
Hear
Yeah. Well said, Emmett. Yeah, I agree.
Okay. So we're just waiting for our friends at Tesla to go live with their call. They should be on in a couple minutes. We will be doing notes live as well. Oops, I didn't mean to do that. And so I'll have a link for that available for you guys to look at once we are live. And then what I do ask from the audience, if you don't mind, if you could mute while the call is going on, so that we can make sure there's no interruptions, and then we'll listen into what the folks at Tesla.
Fazat, can I get out and back in with the same link?
Yes, ma'am, you can.
Okay, I will do that.
Okay, sounds good.
Likewise.
She needs silence to ensure that she can process this.
Come on, it's the age. It's the age.
Oh, please. You don't like
I may
her,
have to disappear like a little while into it, but you guys won't miss me just to go get my kids and stuff. But I'll try to stay on for a while and just listen.
Yeah, and we'll do a post call reaction as well for whoever wants to stay on or come back for that. we'll have notes as well, and we can gather all everyone's thoughts, and obviously also in the comments section, if you guys have any comments, do throw it in. So maybe what I'll do now is maybe I'll just have this. I'll have this going in the background. Everybody, just if you need to take a break, and then we'll get started here shortly. How's that sound? Is that good?
Thanks a lot. Perfect.
Sounds
Okay,
good.
so I'll do that. Okay, let me actually do it this way instead. Let me do it this way. Okay, share system audio. Everybody hear that? Yeah? Yeah, Matt's dancing, so I think that's a yes. Okay, perfect. All right, everybody. So if you're just tuning in, we're just waiting for the earnings call to start from Tesla. I'll be taking notes live for this call. And I'm going to post a link to the notes in the comment section below so you can follow along if needed. And we'll get started. So Tesla Q1 2023 Tesla earnings call. Bars on. Then I'll do a anyone with the link can view. Perfect. And then you can rave with us, or with Tesla in this case, with their crazy music. I'll go ahead and pin the notes in the top of the comment section so you can have easy access to it. And then we'll get started. We have almost 4,400 people joining us today, by the way. It's freaking awesome. Thank you very much. Okay. All right. We'll see if we get demonetized from the music. That'd be hilarious. Gotta hand to them. The music's pretty good. Oops.
Good afternoon, everyone, and welcome to Tesla's first quarter 2023 Q&A webcast. My name is Martin Vieca, VP of Investor Relations, and I'm joined today by Elon Musk, Zachary Kirkhorn, and a number of other executives. Our Q1 results were announced at about 3 p.m. Central Time in the update deck we published at the same link as this webcast. During this call, we will discuss our business outlook and make forward-looking statements. These comments are based on our predictions and expectations as of today. Actual events or results could differ materially due to a number of risks and uncertainties, including those mentioned in our most recent filings with the SEC. During the question and answer portion of today's call, please limit yourself to one question and one follow-up. Please use the raise hand button to join the question queue. But before we jump into Q&A, Elon has some opening remarks. Elon?
Thank you, Martin. So just a Q1 recap. Model Y became the best-selling vehicle of any kind in Europe and the best-selling non-pickup vehicle in the United States. And this is in spite of a lot of challenges in production and delivery. So it's a huge credit to the Tesla team for achieving these great results. It is worth pointing out that the current macro environment remains uncertain. I don't think I'm telling anyone anything people don't already know, especially with large purchases such as cars. And while we reduced prices considerably in early Q1, it's worth noting that our operating margin remains among the best in the industry. We've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin. However, we expect our vehicles over time will be able to generate significant profit through autonomy. So we do believe we're laying the groundwork here, and then it's better to ship a large number of cars at a lower margin and subsequently harvest that margin in the future as we perfect autonomy. This is an extremely important point. Let's see, regarding the Cybertruck, we continue to build alpha versions of the Cybertruck on our pilot line for testing purposes. It's a great product, and we're completing the installation of the volume production line at Giga Texas, and we're anticipating having a delivery event, a great delivery event, probably in Q3. As with all new products, it'll follow an S curve of so production starts out slow and then accelerates. So the Cybertruck is no different. So it's there's tremendous amount of demand for the product, obviously, and it is, in my view, a fantastic product, a Hall of Famer. But as with all new products, it takes time to get the manufacturing line going, and this is really a very radical product. It's not made in the way that other cars are made. So let's see. With regard to Megapack, we're making great progress. Our energy storage deployment reached nearly 4 gigawatt hours in Q1. It's by far the strongest quarter ever. And this growth was achieved thanks to the ongoing ramp at our Megafactory in Lathrop, California. There's still some way to go to reach the full run rate of 40 gigawatt hours per year. And then we additionally announced the start of a new Megafactory in Shanghai. So as we've expected, the stationary storage growth actually will significantly exceed the vehicle growth. Regarding autopilot and full self-driving, we've now crossed over 150 million miles driven by full self-driving beta, and this number is growing exponentially. This is a data advantage that really no one else has. Those who understand AI will understand the importance of data, of training data, and how fundamental that is to achieving an incredible outcome. So, we're also very focused on improving our neural net training capabilities, as is one of the main limiting factors of achieving full autonomy. So we're continuing to simultaneously make significant purchases of NVIDIA GPUs and also putting a lot of effort into Dojo, which we believe has the potential for an order of magnitude improvement in the cost of training. And Dojo also has the potential to become a sellable service that we would offer to other companies in the same way that Amazon Web Services, offers web services, even though it started out as a bookstore. So I really think that the Dojo potential is very significant. In conclusion, we're taking a view that we want to keep making and selling as many cars as we can. Despite this being an uncertain macro environment, this is a good time to increase our lead further, and we'll continue to invest in growth as fast as possible. Once again, I'd like to give a huge thanks to all Tesla employees worldwide for doing an incredible job again, and super appreciated.
Thank you very much. And Zach has some remarks as well.
Yeah, thanks, Martin. I want to start by congratulating the Tesla team for record vehicle production and deliveries. And I also want to congratulate our energy storage team for record volumes as well. There's 3 main points I want to make. First, automotive gross margin and operating margin reduced sequentially, but as Elon mentioned, these remain at healthy levels. In particular, automotive gross margin was impacted by a few factors since our discussion on the last earnings call, which include additional action taken in the second half of the quarter to improve vehicle pricing, and one-time items, most notably warranty adjustments on older S and X vehicles, as well as increased deferred revenue for certain autopilot features as we transition technologies. Progress on vehicle cost reduction continued in Q1 with meaningful improvements on logistics and the beginnings of some commodity cost reductions starting to be realized. Per unit costs for Austin and Berlin improved as well, driven by record volumes. However, these factories still provide a margin headwind and will likely continue to do so until after we reach and stabilize at our intended volumes. Note that Q1 was our third quarter in our multi-quarter plan to move to a more regionally balanced mix of build and deliveries. As I've mentioned previously, this results in lower deliveries and production within a quarter due to a higher volume of cars in transit at the end of the quarter, and has an associated impact on quarter-ending free cash flows. This was particularly prevalent in Q1 for S and X as we begin exporting cars for international deliveries. Second, our storage business is starting to take shape, and this is exciting to see after many years of investment and focus. This business is growing as a percentage of the company's revenue and reached its highest level yet in Q1, driven by an increasing rate of deliveries for our Megapack products. We are also making progress on storage profitability, generating our highest gross profit yet in the quarter. Third, I want to reiterate the philosophy by which we are operating the business this year. Our approach is to grow volumes as quickly as possible in both our vehicle and energy businesses. We plan to continue to invest heavily into our future plans, which include the Cybertruck, next generation platform, in-house cell production, energy storage business, and our autonomy and AI-enabled products. And we plan to do this while keeping the business financially healthy and industry leading. To accomplish this, we need to remain focused on cost efficiency and working capital, and in particular, unwinding the strategic inventory buildup left over from the pandemic. I want to conclude by thanking the Tesla team again, as well as thanking our suppliers and our customers.
Thank you very much. And let's go to investor questions on say.com. The first one is, what is the process to make auto pricing adjustments? What variables do you consider? How frequently do you review pricing?
Do you want to take that, Elon, or do you want me to take it?
My apologies, sorry, I was on mute. Yeah, I think this is not something that we can really talk about. It's just we do our best to evaluate the production output, macroeconomic conditions, and we make a decision. But it's unless there's something you'd like to add, Zach.
No, I think that's right. I mean, as a team, we review where we stand globally on a weekly basis, and certainly can't get into the details of the reasons why certain decisions are made. But it is something that's very actively managed by a subset of the leadership team.
Thank you. The second question is, do you still believe Tesla Energy will be bigger than auto? And when will you provide more formal guidance on Megapack and overall Tesla Energy?
Yeah, I should just clarify, like bigger than auto from the standpoint of like total gigawatt hours deployed. So it's possible automotive revenue may be higher, but gigawatt hours I think will be probably higher with stationary storage. If you just look at what's needed to transition the world to a sustainable energy economy, there is more stationary energy storage needed than there is mobile energy storage. So and we are seeing growth of our stationary storage well in excess of automotive. So that is in line with expectations.
Yeah, and on the guidance part of the question, and maybe Martin, we can combine this with the next question, which is on guidance for margins. Just have a single comment there. I think we will get to the point where we as a company provide guidance on the storage business. I say storage, the combination of both the Megapack business and the Powerwall business. Relative to total revenues of the company, it's still fairly small. And the business has a lot of volatility currently, both in terms of volumes as well as financials, just given the small volumes and kind of diversification of the customer pool there. But as this business grows and smooths out, I don't think we're that far away from it. I think including these volumes on our day 2 production and deliveries release is something that we'll start doing. And then we can talk more formally as a business about our expectations over the coming year. I think it'll be a few more quarters before we get there.
Thank you. The next question, as you said, was already answered. So let's go to the battery question.
Oh, sorry, just one other thing I wanted to mention on margin. While we're not providing specific guidance there, I mean, just to set expectations of where we think this business will go in terms of margins, probably generally in the ballpark of what we've seen historically on the vehicle business. We generally look to mid 20% gross margins for any program that we launch. And so we're not there yet on this business, but that's what we're working towards.
We're hopeful to get there later this year, but that's not a promise. That's an aspiration.
Thank you. The next question is, how well are 4680 cells meeting the expectations described on the battery day? How long will it be until the cells meet those goals? Drew?
Yeah. So on Battery Day, we established a cost down roadmap through 2026 across 5 areas of effort. There was the cell design we discussed, anode cathode materials, the structural pack concept, and the cell factory itself. We've been making progress across all these aspects since then. For the cell factory, the Texas 4680 factory, we are partway through building and commissioning and installing and operating. Will be 70% lower capex per gigawatt hour than typical cell factories when fully ramped, in line with what we described on Battery Day. And we're continuing to further pursue densification and investment reduction opportunities in future factory buildouts like in Nevada. On the cell design, we're in production with not only the first generation tablet cell we unveiled on Battery Day, but a second, more manufacturable version in Texas today. On the cathode material side, we have a number of activities underway per the Battery Day roadmap. For lithium, our Corpus Christi lithium refinery breaks ground this May. Our goal is to start commissioning portions of the facility before the end of the year. The refinery uses the sulfate-free spodumene refining process with reduced process costs, no acid or caustic reagents, lower embodied energy, and actually produces a beneficial byproduct that can be repurposed in construction materials. We discussed all of these concepts on Battery Day. Same with cathode precursor. We've successfully demonstrated a lower process cost, zero wastewater precursor process that we described on Battery Day at both lab and pilot scale, and are in the detailed design phase for incorporating this technology into the front end of our Austin cathode facility. On cathode production, we are 50% equipment and 75% utilities installed at our new cathode building in Austin, with our goal to begin dry and wet commissioning this quarter and next quarter, with a target to produce first material before the end of the year. Structural pack, we saw big improvements with pack manufacturing with the 4680 cell and the structural pack concept, 50% lower capex and 66% smaller factory for the same output in gigawatt hours per year. We do believe structural as a concept is a good one. It's simpler. We'll continue to structurally load the cells and use the pack as the floor of the vehicle, while iterating the design to closer to B-level execution of this A-level architecture in future programs. And zooming out for the 4680 team, Q1 was all about cost and quality. We made significant improvements in both areas. On Texas, production increased 50% quarter over quarter. Through yields increased 12%, and Cato peak rate increased by 20%, and through yields improved by 20%. Altogether, the team accomplished a 25% reduction in COGS over the quarter, and we are on track to achieve steady state cost targets over the next 12 months. And going forward for the rest of the year, the priority one is yielding cost for the 4680 program as we steadily ramp production ahead of Cybertruck next year.
Thank you very much. The next question is, what do you anticipate 2023 automotive gross margins ex credits will be at the company's current pricing levels?
Yeah, I can start off on this one. This is a difficult environment to make a projection like this. There's a lot of macro uncertainty. There's also headwinds and tailwinds. And, this is basically a question I think that's asking about our viewpoint on where costs will go. And within costs, there's a set of costs in which we do control, a set of costs in which we're kind of subject to what's going on in the macro world. Within the bucket of things we control, the most of the cost down that we're working on is around ramping our Austin factory, stabilizing that, and then doing the cost optimization work once we get to our intended volumes there. And a part of the cost journey in the Austin factory is, as Drew mentioned, the 4680 cell, which is an input into our Austin COGS. And so, as the 4680 program improves over the course of the year on cost, as Drew mentioned, and then the non-cell portion of the factory improves, we see a pretty good trajectory in the Austin facility. A similar story exists in the Berlin factory. It does not have 4680 as an input, but for that factory, the journey to complete localization is still ongoing. And so over the course of this year, as volume increases, more localization occurs, we do see a good path to cost reduction in the Berlin factory as well. In existing factories too, we talk about this on every call, so I don't need to rehash it, but the expectation is that every existing factory improves all of their key metrics, and we continue to see the progress there. There's also a handful of other costs in which we have influence, but the philosophy here is that we're aggressively going across every cost bucket that we can. Within the world that we don't control, the two major costs there being logistics, which fortunately is moving in our favor. And I think our supply chain team has done a great job both on logistics optimization and taking advantage of reduced spot rates where they can. So thank you to our supply chain team. And then there's the commodities world, which has been a huge page point in our cost structure over the last, say, 2 years or so. And we're still kind of at the maximum of paying for commodities in our cost structure. It kind of maxed out in the second half of last year. We did start to see in Q1 a little bit of improvement. We think there'll be a little bit more improvement in Q2. But
lithium has dropped a lot. It's worth mentioning that the price of lithium has dropped significantly.
Yeah, and that's the piece that we expect to see more impact from in Q2. And generally, as a company, we do expect commodity prices to come down and have a more meaningful impact in the second half of the year.
Yeah.
So, this is our approach. How that nets out, I mean, there's just a lot of risk, and we'll have to see how the year progresses.
Thank you. The next question is, how has global order intake tracked since the most recent round of price cuts?
I think the overall thing we can say is that orders are in excess of production.
Thank you. And maybe the last question from investors. Can you give updated specs and pricing for Cybertruck and any new features that will make it to production?
Well, I think we'll save that for the Cybertruck handover, which will hopefully be around the end of Q3 this year. And one thing I am confident of saying is that it's an incredible product. It's a Hall of Famer, I think. And a product like this only comes along once in a long while. So people will not be disappointed at all. It's amazing.
Great. Thank you very much. And let's go to analyst questions. We'll start with Alex Potter from Piper Sandler. Alex, go ahead and unmute.
Can you hear me?
Yep.
Yes.
Okay, perfect. So first question was on Lathrop. Obviously, it's great to see the growth there. Just wondering when you think that facility might be closer to full utilization. Are you just sort of deliberately working your way up the S-curve there? Demand obviously isn't the limitation. So what are the steps, I guess, to unlocking full utilization there?
Sure. There are some classic, factory ramp aspects of what's going on in Lathrop. We actually have 2 phases of the CapEx there. We phased some of the general assembly parts of the facility. But in addition, we also have ramps with our suppliers that we are following. So both on the cell side and on the power electronic side. And we will see that unlock in the latter half of this year with both those inputs. So the overall facility was phased with the second phase of CapEx coming online towards the end of this year.
Okay, great. And then I guess my second question is on your ability to serve other markets out of Shanghai. Obviously, the facility in Berlin should be opening up your ability to, I guess, allocate more vehicles to Southeast Asia, Australia, other areas. I'm just wondering what other regions you think you're maybe not yet serving effectively. What are your timelines for addressing some of those gaps in your regional exposure? Thanks.
Yes, that's a good question because there are still many parts of the world that we do not yet serve with respect to vehicles, especially. So we do expect to open up new markets around the world. And while those markets are not necessarily individually gigantic, they do add up to, if you add up a whole bunch of markets, they do collectively sum up to something significant. So it's high time that Tesla offered its cars to the rest of the world, and that is something that we intend to do.
Okay. Thank you very much. Let's go to the next analyst, George from Canaccord. Go ahead and unmute.
Hi, thanks for taking my question. I was wondering first if you could discuss your FSD take rates and whether you've seen any significant positive or negative change there. And also, given that you've reduced the prices for your vehicles, do you think you need to do that for FSD as well? Thanks.
Well, I'll decline to answer the details on the FSD take rate, but it's a tricky pricing question because the value of a car that is autonomous is enormous. So in a way, the price right now is an option value on an autonomous vehicle, and that value is that will ultimately be very significant. And it's really. Yeah, I mean, for those that are using the FSD beta, I think you can see the improvements are really quite dramatic. There'll be a little bit of 2 steps forward, 1 step back between releases, and for those trying the beta. But the trend is very clearly towards full self-driving, towards full autonomy, and I hesitate to say this, but I think we'll do it this year. So that's what it looks like. Yeah.
Thank you. Maybe on the dramatic change we've seen in EV-related commodity prices, do you think that's a reflection of any recent overcapacity in mining and refining, or is that sort of a coincident indicator on global EV demand? And how do you expect those prices to kind of track over the next several quarters? Thank you.
And I wish I had a crystal ball to answer your question. I don't know if we can provide a question that would that would have any value really. I think we're in uncertain times, and if somebody's got a crystal ball they can lend me, I'd really like to borrow it. But these are uncertain times. My guess is it's economic stormy weather for about a year or so, and then it will hold roughly 12 months, and then this is just my guess. It's just pure speculation. Stormy weather for about 12 months, and then provided there are no major geopolitical wild cards that show up, things start getting sunny around spring next year.
The only thing I would say on the EV materials markets, they're not all super liquid, and some of them, for example, less than single-digit percentage of the market is actually traded on the spot market. And not only are they not super liquid, there's not storage isn't particularly facile for all of the materials. So small mismatches in supply and demand drive large price swings, not really real price swings, but just temporarily large price swings. So it's hard to read into those price swings. I don't know, Karn, if you want to add anything.
Well, but this one, by the way, we are seeing, as Elon mentioned, quite a bit of softening in the lithium carbonate market. This was, 6 months ago, we were trading at $85,000 a ton, and today's spot price is about 26. So there's been a dramatic decrease in that. Of course, we were able to take advantage of low lithium pricing earlier on with fixed price contracts, and we find that this is going to be another opportune moment to basically extend that into the later half of the decade. But we at the quantities we're procuring, we're not as impacted by the spot market because we have those contracts in place, and we're just going to be going and doing more of that. The other thing that's happening is because of the price spike, a lot of the companies that are in this business are becoming more ambitious about finding more upstream resources and exploring locations in Africa as well as South America. So that's also helping the macro situation with pricing.
Yeah. But just on the lithium front, to emphasize the choke point is much more on refining capacity than it is on mining. Lithium is actually is very common throughout the world, including in the U.S. and really it's just a very common element on Earth is lithium. So it's much more a question of where's the refining capacity and can the refining capacity keep up? That's really what matters more than where is the lithium ore. It's everywhere basically. I think that same question also extends to refining of the cathode, and to some degree refining of the anode. And this is why we've at Tesla we're building our lithium refinery capability at Corpus Christi, and our cathode refinery outside Austin. It's worth noting. Like I hope other companies do the same thing. We'll have by far the most lithium refining capability and the most cathode refining capability in North America. I think probably more than everyone else combined, by a lot. So can other people please do this work? That would be great. We're begging you. we don't want to do it. Can someone please, like, instead of making a picture sharing app, please refine lithium, mining and refining, heavy industry. Come on.
It's fun. It's actually fun.
Yeah, exactly. It's real.
You have a customer. We're here, ready to buy.
Yeah, that's right. I just want to emphasize, Tesla's not doing this because we want to do it. We have a lot of fish to fry, obviously, but we're doing it because others aren't doing it, and we wish others would do it.
Awesome. Thank you very much. Let's go to Emmanuel Rosner from Deutsche Bank. Hey, Emmanuel, can you
hear me?
Yeah, we can.
Yep. Perfect. Thank you so much for taking my question. Maybe a first question for Elon on your pricing strategy. So if I understand your message, you're saying, Tesla feels it's worth maximizing the volume, increasing the size of the fleet as fast as you can, because you'll be able to monetize this over the life cycle of the vehicle. Could you be a little bit more specific around ways you would be able to monetize sort of like this existing fleet in the future? Obviously, I think autonomous seems to be a big piece of it. By my understanding was that robotaxi would probably be for the next generation vehicle, not the existing one. So I guess in which ways would you monetize it?
That's right. The robotaxi terminology can be a bit confusing because that's sort of like a generic term for our next generation vehicle. And we obviously are working on next generation vehicle. It's going to be very compelling. This is just not the time to talk about it in detail as a product. So we internally call it robotaxi, but really all of the vehicles that have hardware 3, which is the vast majority of our fleet, we believe will achieve full autonomy. So they will be like a Model 3 or Model Y would be a robotaxi, a robotic taxi. So yeah, that's to the best of my knowledge that we believe that the current hardware can achieve full autonomy.
Understood. And then maybe a question for Zach, back on the automotive gross margin. So I guess a few months ago, even after major price cuts, you felt pretty strongly that 20% automotive gross margin was still probably a reasonable floor. Obviously, the macro has gone worse, and additional price cuts have happened. Is there anything else that has changed in terms of the outlook? Is it just the macro deteriorating? Is it the competitive landscape? Anything else that sort of like makes you think differently around the full year? And is there a way therefore to frame a floor?
Yeah, about half of the miss against that previous conversation last quarter is attributed to adjustments we made in pricing in the second half of the quarter. I guess you could argue that lowers the floor in a sense. We've also made pricing adjustments so far this quarter, so that brings it down further. About the other half of the miss in Q1 was attributed to things that are non-recurring. So I mentioned these in my opening remarks. It's a warranty adjustment for cars that were previously produced, but not part of the pedigree of cars we're building now. and some autopilot related deferrals as we make some technology changes here that those deferrals should get recognized once some of the software catches up. So those two things are non-repeating. So hopefully that helps answer your question.
Yeah, I mean, there's really two macro factors that are tricky. The biggest being the interest rate. So if there's a very high Fed rate or interest rates are very high, that is every time that the Fed raises interest rates, that's equivalent to increasing the price of a car. It makes the cars less affordable because people are able to buy cars as a function of what they can afford on a monthly basis. So it's just almost directly equivalent to a price increase is any kind of interest rate increase. Then the other factor is whenever there's uncertainty in the economy, people will generally postpone new capital purchases like a new car. So it's a natural human reaction. So if people are reading about layoffs and whatnot in the press, they're like, well, they might be worried about they might be laid off, so then they'll be naturally a little more hesitant than they would otherwise be to buy a new car. Now this is just the nature of the auto industry. But there will be a tremendous amount of pent up demand for new cars. So, but it goes through cycles.
Thank you. Let's go to Ben Kalo from Baird. Ben, go ahead and unmute.
Hey guys, Elon, when you talk about many fish to fry, you talked about Dojo being a product that you can sell outside Tesla. How do we rank all the things you have going on, and then in the economic environment? I mean, like heat pumps and everything else you have going on versus investing in the vehicle business, or is that not the right way to look at it?
I'm not sure I fully understand your question, but I'd look at Dojo as like kind of a long shot bet. But if it's a long shot bet that pays off, it'll pay off in a very, very big way. But potentially, potentially in a very, very big way. Like, in the multi-$100-billion level. But the thing with still put it in the long shot category, but long shot with a multi-$100-billion potential outcome. And so it's a bet worth making, but not one you can sort of say like, oh, take it to the bank type of thing. Although these days, take it to the bank, it's maybe not as secure as it used to be. And obviously we're big believers in heat pumps, and that is on our list that over time is to do a really good heat pump for homes and commercial offices and stuff. And we have the technology; it's really good, but it's still a back burner item. Our focus is very much on vehicles, autonomy, stationary storage, basically solving sustainable energy and solving autonomy, which would be from, like it says, solving autonomy. If we're able to have a fleet of several million vehicles that, with a software update, can be potentially worth several times their original value, that will be, if that happens, that will be and I think it will happen. That'll be the biggest asset value increase in history, I think.
Thank you. Just on pricing, a lot of pundits talk about pie and losing share or gaining share, but how do you guys look at pricing versus the EVs or the ICE vehicles, or does that not come into the equation? Sorry to ask about pricing again. Thank you.
No, it's really just like we're every day we get a daily real-time update of how many cars were ordered yesterday, how many cars were produced yesterday. We must have if there's a company that's got more real-time data than Tesla, I'm not sure there's any company on earth that has better real-time data than Tesla, except maybe SpaceX, Starlink. So because like we don't have to, for the other car companies, they will make the cars, send them to the dealers, then the dealers will sell the cars, and then it takes quite a long time for them to get the data back to actually figure out how many cars are sold. Whereas we know how many cars were ordered yesterday throughout the world. So our fingers on the pulse is real time and does not have latency, whereas the other car companies have a lot of latency in their data, as does the government. The government has a lot of latency in their data. So we're just looking at and saying, okay, what does it take to achieve a clearing price for our vehicle production? And then we make a pricing change and we see what happens immediately, and adjust course. So we're adjusting course, and we're thinking about it literally every day, 7 days a week. Every 7 days a week, I look at that email, and so does the rest of the team. And we try to make the least dumb decision that we can. And on balance, I think our decisions are pretty good. Sometimes they'll be, dumb, but on average, they're, I think, better than the rest of the industry.
Just to add on the question about EV market share or ICE, this comes up a lot. I think a lot of the public debate is around this concept of EV market share. We don't look at it that way. I mean, we look at it as market share of cars. It's the car market, not the EV market. And actually, the mission of the company requires internal combustion engine cars to be switched over to electric vehicles. So that's what we pay attention to.
Yeah, I said that last time too. You guys got to stop looking at it as the EV market. It's how many cars are we selling? Just start looking at it that way.
All cars will be EVs. It's gonna. I've said this for a long time. We'll look back. I don't know. Assuming civilization's still around in 20 years, we'll look back on internal combustion engine vehicles the same way we look back on external combustion engine vehicles, which, like a steam engine. A steam engine is an external combustion engine vehicle, and there's still a few around. They're kind of quirky and kind of cool collector's items. That's how gasoline cars will be in the future.
Thank you. Let's go to Colin Rush from Oppenheimer. Colin, go ahead and unmute, please.
Thanks so much, guys. Can you talk a little bit about how much of the actual cost structure is variable, on these vehicles, and if you could give us a range on plus or minus the lithium cost within those contracted volumes that you're seeing?
Well, I think again, we'd really love to have a crystal ball here, but we don't have it. Depending on what time scale you're looking at, most of the car is variable. Most of the car cost is variable. And probably, if I were to guess, I think we will see improved costs from suppliers. I think we will.
Yeah.
That is our expectation.
Yep, and we're already starting to see that. Elon, I think you had mentioned before that we anticipated a crash in the lithium prices, and some of that has flowed through by way of lithium carbonate reductions into battery cost. And the same thing will happen with lithium hydroxide. The length of the supply chain matters also, because what we're talking about is very far upstream. So by the time it makes it into the battery that's up in a car, it'll be several months. But beyond just the commodity pricing, as Zach mentioned earlier, we're also very focused on other metrics that make production very efficient. So, for example, detention and demurrage, air expedites. I think our air expedites are down 90%. Detention and demurrage is down 93% from the peaks. That can be hundreds of thousands of dollars per vehicle. So we're sort of attacking all vectors and becoming very efficient.
Okay, and then my follow-up is really around stationary storage demand on the utility scale. I mean, obviously there's a gigantic queue for interconnection in the U.S. And can you talk about the volume of quotation you're seeing at this point around stationary storage for that renewables queue? on a global basis, and how much of that is converting into actual sales?
Drew, you want to take that?
I mean, I don't, that's also not exactly how we look at it, really. We're not we're not engaged in the interconnection queue. Like, we're focused on ramping Megapack as quickly and efficiently as we can. And we have, visibility into the pipelines of, a variety of different renewable energy and just pure stationary storage developers. And we also develop our own projects. And we're mostly just we're being selective and trying to pick the projects that best fit our mission and our objectives.
Yeah, this is not a product call, but we'll have something. I mean, we're making improvements on many fronts, including Megapack. So I think some of those improvements will improve the speed at which you can connect the Megapacks to the grid.
Thank you. The next question is from Mark Delaney from Goldman Sachs.
Yes, good afternoon. Thank you for taking the question. Do you still see 2 million units as an upside case for volume this year? And is the gating factor for reaching 1.8 million or 2 million units in 2023 still supply chain, as was mentioned on your last conference call, or is it more about demand at this point?
Well, if you have a crystal ball, you can lend me back to the crystal ball situation. These are volatile times. From a production standpoint, if things go well, we've got a shot at 2 million vehicles this year. But that is the upside case. And we feel comfortable with 1.8. And we'll have to see how this year unfolds.
That's helpful, thanks. And then the company has spoken at the Investor Day and then some of the past conference calls about opening up its vehicle charging network. Can you speak to some of the feedback you've been getting from both Tesla owners and non-Tesla owners, and how the ramp of the charging network may progress from here? Thanks.
Drew, you want to take that?
Yeah. So as you may have seen, we opened our first V4 post in Europe and our Magic Dock post in North America in Q1. And that is, indicative of the direction we're heading with, universal compatibility for all vehicles of, no matter where the charge port is, et cetera, in all major markets. And we're going to continue to roll out those sort of improved offerings as we build new stations. We're always balancing like our ability to serve our own customers with our ability to serve new customers when doing that. I think we've been able to balance it rather well. For example, in Europe, 50% of all of our supercharging stations are open to all EVs, and we've been able to do that without any increase in wait times at all for anybody. So we're going to continue to take a similar approach as we do this in North America and China over the coming quarters.
Okay, thank you very much. Let's go to Rod Lache from Wolfe Research.
Hi, everybody. I just wanted to first just follow up on your comments in your letter about leveraging your cost position as others struggle with unit economics, and also taking into account the lifetime revenue, actually in a way that most other automakers will never see, just given your service network and supercharging and other attributes. Can you just maybe give us a sense of how far you'd be willing to take this? Are there brackets around the range of initial margin that you'd be comfortable with? And again, any color that you might provide on the updated range of margins that you'd expect in the auto business?
I think we may have answered this question or tried to answer this question a few times, but it's difficult to say what the margin will be. It depends on what the macroeconomic environment is like. So for example, if the Fed were to lower the rates, that would be super helpful for demand. If they raise them, that just raises the interest cost that buyers have to pay to buy a car, so it reduces affordability and therefore reduces demand. So it's, but if we look past, say, this year or like go sometime next year, middle of next year or something. I think things are looking really. I think, like I said, all bets are off if there's some major geopolitical wild card that turns up. But in the absence of that, I think I would be very optimistic about middle of next year and the next year.
Yeah, and just to add to Elon's comments, just two other points. What's really important for us this year, in addition to just managing the day-to-day of the business, but is also investing in, as Elon mentions, what 2024 and 2025 will look like. And so, using the cash generated from the sale of products today and reinvesting that, this is very important for us. I think that what happens to margins over the next couple of quarters only matters in the context of what that means for our ability to reinvest into 2024 and 2025. And we have a lot of space before that becomes something that we have to revisit our investment plans. And so, we're planning to keep the business healthy. But I just want to caution folks about reading too much into what happens over the near term here, because we're very focused as a company on making sure that when we exit this macroeconomic situation, this company is positioned in the best possible way.
Yeah, exactly.
Just to elaborate on that point, though, the revenue, the long-term lifetime revenue that you're targeting from each vehicle is massive. So if you took that to the extreme, it would seem that you'd be comfortable with a relatively low initial margin. Am I misinterpreting that, or is that exactly right? And just,
that is exactly right.
Okay. And the normally in a recession, when consumers feel less financially secure, actually price elasticity deteriorates. Just based on your pulse taking of the consumer, do you have a view on elasticity of demand?
Well, I can't emphasize enough the whole this fundamental question of affordability. For most people, their ability to buy a car is a function of can they make the monthly payment or not. And so like I said, if interest rates are really high like they are right now, then in some cases people can't get a loan at all. So it's and I think probably banks are pretty not leaning forward in providing loans. I expect these days. So so that's but like there is quite a powerful story here when going back to something I was alluded to a moment ago, or mentioned a moment ago, that Tesla is in a uniquely strong strategic position because we're the only ones making cars that technically we could sell for zero profit for now, and then yield actually tremendous economics in the future, but through autonomy. No one else can do that. I'm not sure how many people will appreciate the profundity of what I've just said, but it is extremely significant.
Thank you. Let's go to Adam Jonas from Morgan Stanley.
Hi, everybody. So first, Elon, good luck with tomorrow's launch at Boca Chica. Break a leg.
We definitely we can't have too much luck in the rocket business, that's for sure.
That's incredible. So now that you've gotten to know the Twitter architecture kind of intimately over the past 6 months, what can you tell Tesla stakeholders about how an X.com or super app could be potentially accelerative to Tesla's business model?
Well, I don't know. I guess it could make it potentially make it easier to buy cars. So, but we are straying somewhat off topic here because this is
okay. All right.
I think there's some benefit. I think probably there's some benefit. Yeah, sure.
I get it, Elon. So just as a follow-up on manufacturing, you're a student of history. And
Yes.
you'll know that back in 1913, Henry Ford introduced the moving assembly line in Highland Park, Michigan. And the price of a Model T, which had already, been undercutting cars around the time, fell another 70 or 80%, and hundreds of rival car companies went bust.
Yeah.
I'm wondering if history is repeating itself here, Elon, and that the recent pattern of cuts with you is way ahead of the cost curve compared to competition, or is this? It seems like it's a calculated strategy, not just in reaction to competition or changing supply demand in the market, but could we catalyze some Darwinian forces in the EV market?
Well, I mean, we're not trying to say take pricing actions in order to be deliberately undermine competitors or anything like that. We really don't think about competitors that much. We just look at, do people like our cars? How can we make the product better? Can they afford our cars? The sort of the things like improving service and whatnot. But like I said, we do have this unique strategic advantage that we're making a car that if autonomy pans out, and we think it will, where that asset is actually will be worth a hell of a lot more in the future than it is now. So it is technically possible to sell it at zero profit, but still have the net present value of future cash flows associated with that asset be very significant.
Yeah. And service and charging and insurance and all of these other ongoing revenue streams that other companies don't have.
Yeah.
Certainly, we want all EVs to succeed too. We just want to say that we're not in like some malicious attack to try to just crush everybody.
Definitely not. We're like opening up superchargers. We've made our patents available for free. So it's like we're trying to be helpful here, So we're not out to sort of destroy competitors or anything like that. We're trying to help competitors, frankly, in any way that we can.
Thank you. Let's go to Dan Levi from Barclays.
Hi, good evening. Thank you. First question, you're ramping supply at Austin and Berlin. So I wanted to understand just how critical it is to further increase volume at those plants just to get the vertical integration benefits in the face of the sort of market with some demand questions. And just broadly, should we historically you've been operating at the pace at which your supply allows you to produce as opposed to gauging to demand. Should we generally expect that you're going to continue to produce at your whatever the max capacity that you're allowed within your supply constraints, regardless of what the broader economic environment is, just to continue to get that volume out there?
That is, yes. I mean, there could be like obviously a macro shock that is so severe that people just stop buying cars for some reason. But in the absence of that, we will continue to grow output at a rapid clip.
Great, thank you. And then just on the margins associated with Austin and Berlin, you mentioned Austin and Berlin have a margin drag until you reach intended volumes. I don't know if you can disclose what those volumes are. And maybe you could just remind us of what the margin profile of Austin and Berlin will look like versus Shanghai once you get the vertical integration benefits in place.
Well, probably won't have be quite as good as Shanghai. Shanghai is hard to, has a very efficient cost structure. It's obviously our lowest cost structure in the world. But we do expect to be make significant improvements in Austin and Berlin, and continue to make improvements in Fremont as well. So, yeah,
we've increased, this is Roshan by the way, we increased our localization efforts, so that will then drive down days on-hand requirements. We've made 10% quarter-over-quarter improvement in days on-hand. So we'll continue that path as the localization improves.
Okay, thank you very much. And our final question comes from Philippe Couchois from Jefferies.
Yes, good evening. Thanks for taking the question.
It's slightly longer term. I completely agree with your comments that we should look at Tesla in terms of auto market share, not EV market share. But I'm just wondering, as you build up the market share globally, is there a limit to the direct selling business model as you practice it? And should we think about going forward, you need to look into the agency or using importers to basically develop market share more smoothly, I guess, globally? And so in other words, is there kind of a sell by date for the direct business model as you practice it today?
Seems to be working well so far.
Because we hear different feedback from customers who miss the human interaction or unhappy with the service, and I'm just wondering if you're seeing some growth pains in there that would lead you to change. You're not seeing that.
Well, I mean, there are since we're always going to have some growing pains where at times, and it depends on which geography we're talking about, where sometimes service is behind sales, sometimes it's ahead of sales. This is I mean, Tesla's growing, I believe, faster than any company in history that makes a large, complex manufactured object. So, these are, if you're trying to max, it's always difficult to match exponentials. But I think it is helpful to have the feedback loop with service, because that means we feel the pain of service, and then we can adjust the design to make the car need less service. And I think that gives us the right incentive structure, because the best service is no service. The car doesn't break. And whereas if you have, say, a dealer network that is reliant upon service as a revenue, then you arguably have a misalignment of incentives, where they're making money on service, but actually we want to, the best thing for the consumer is the car doesn't need servicing. So.
Yeah. And on that front, if I can follow up, have you worked out, I mean, for many of your traditional competitors, a fair amount of profits for them comes from selling spare parts and servicing, and you don't have that in your profit structure. And have you worked out how much of a deficit you have compared to your peers?
Yeah, actually, I mean, this one's something I could wax on about for a while, because really people didn't understand that the best short-selling argument against Tesla for the longest time was the fact that Tesla does not have an existing fleet, and that the auto industry, the reason incumbents succeed and newcomers fail, the biggest reason is that the incumbents have a large fleet, and they're able to sell new cars at close to zero margin, and then sell spare parts at a very high margin, sort of razors and blades type thing. And so the only way to actually succeed, for a newcomer to succeed, is to have a product that is so compelling that people are willing to pay a premium over the incumbent product. And in the absence of electrification and autonomy, I don't think a newcomer can succeed.
Thank you very much, everyone. Unfortunately, that's all the time we have for this quarter. We'll see you again in 3 months from now. Thank you.
Yeah. 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 What'd you think? We're back. What'd you think? Give me your thoughts right now, all of them. Go.
Everything. Yeah.
By the way, can I just say before you say anything, I'm sorry, dude, your impressions were insane. Like there were like things you called to the T. If you just joined us, Matt did an impression of Zach and Elon earlier on. I think about an hour and 15 minutes in. Do check it out. I'm sure my clips guy will make a clip out of it. David, if you watch this, go make a clip out of that stuff, and let's throw Matt a couple bucks for his performance, to a charity of his choice. But yeah, go ahead, share us your thoughts. I hit the like for Matt GPT. Go for it.
Yeah, I mean, so the first thing that kind of stuck out was our order rate is higher than our production rate. So my first reaction was like, oh, that's amazing. That's really good news. It kind of gives credibility. But then I was like, okay, over what time frame are you measuring that, that difference? Because it seems like if you were measuring January to March, that probably wasn't the truth, or at least like mid-January, late January to the end of March. I'm sure that was probably not the case. So yeah, that was, kind of interesting. FSD, like complete later this year. I thought that was pretty interesting. And I thought it was great that he actually clarified for us kind of nerds that hardware 3 he thinks will be like robotaxi capable. So I thought that was pretty good. But overall, I saw a lot of people in the comments and on Twitter seemed pretty unhappy or saying like it was a terrible report. I don't think so. I mean, it was not a home run for sure. But the long-term guidance, I think, like over the course of the last 2 hours, I think I've become increasingly more bullish on the company in the long term. I mean, think about what he was saying about this point next year, the position they're going to be in relative to GM, Ford, everybody else. Like, oh my gosh, it's like, yeah, I don't know what's going to happen over the next 12 months, but after that, I'm just so it's like I'm kind of unbelievable to think the shape that they're going to be in.
Yeah, I think for me the biggest thing is that I'm glad to see that the company did sort of address the guidance sort of misses they had in the last quarter around margin. So that was good to see. They didn't just brush it off. It's like, hey, whatever. It's just, and they kept mentioning a crystal ball, but Zach did say, hey, I gave you 20, ended up being 18. Half of it was the pricing adjustments because of macro. The other half was because of one-time items. So that was good. That was very good that they owned up to that, because I do think it's important to build trust with the investing community when it comes to that and kind of like own up to sort of like an error that you made. And I guess, yeah, it's impossible. I get it. It's very, very difficult to set an expectation out there for these margins and things. But I think it's very important for them to come out and say something like that. I think the tone I'm getting from them, and I'm very curious to hear, is that we're very much in a recessionary environment, and they basically said recession 1,000 times without actually saying the word recession, based on the verbiage that we're using on certain macroeconomic times. How did you perceive that? Do you think that came across clearly, and that's why Tesla decided to lower its prices because we're literally in a recession? That was my takeaway.
Yeah, I mean, I love that they didn't beat around the bush. I mean, I think the worst thing would have been if Elon just came out and said, like, oh, everything's, fine. And if we have any weakness, it's like Jerome Powell's fault. He said like things to that effect, I think not very tactfully before. And I thought this time around, he was pretty tactful, and Zach too, about saying, yeah, like this is an uncertain time. We don't know exactly what's going to happen. In terms of demand over the next couple months. But I thought they did a reasonable job kind of discussing the room that they've got around margins and everything like that. So yeah, I think it kind of ticked a lot of the boxes I was looking for them to tick. I mean, absent like some huge miss, like, oh, we actually have every single car that we produced already has an owner, and we've got a 6-month backlog, but it's just not showing up, like some crazy thing like that is just like a Uber Bowl fantasy. Absent that, I thought it was a very strong, kind of grounded in reality update about the way that they're ramping. So yeah, I thought that was really impressive, actually.
Yeah, I really did feel like they did a really good job setting expectations to the lower end. They said, hey, margins, basically the message I got is like profits will go down, margins will go down. We're going to keep ramping volume, and in an uncertain macroeconomic environment, unless literally nobody's buying cars anymore, we're going to keep lowering price to match the production of our factory. Our factory to our.
Did you lose a lung?
Off and trying to say a word at the same time. Yes, I have a collapse.
Yeah, okay.
So that was that's what I'm getting. So this gives me, I think for this quarter, one of my errors that I'm going to go back and fix for the following quarters, that I'm still a little too bullish on their ability to surprise on the cost side in the near term. And it's clear that that's not the case. It's clear that a lot of these things have room to go, and that their ability to sell cars at the pricing levels they started at the quarter clearly we're not low enough to continue stoking demand. And if we take the guidance from the management at face value, saying that, hey, the lowering on the cost, half of it was literally because people are not buying our cars as much as we thought, which is kind of what they said, right?
Yeah.
Way. Then at those pricing levels, then it's like, okay, so the economy is slowing dramatically. And so the check for me is going to be, okay, let me check the other channels. Let me look at Ford, GM, Hyundai, Toyota. And, as I look at those numbers, it kind of line up with the same thing. People have stopped buying cars. People are just not buying expensive cars anymore. And so, yeah. And so getting that sort of tone from Tesla as well reconfirms that sort of feeling that I have. Go ahead.
Yeah. I was just thinking, like, the kind of inventory buildup that Tesla has had over the last, was it 3 quarters or so, has been a drag on free cash flow, like Alexandra pointed out, and I think it's reasonable. But they're at like 11 days. What, you've been tracking GM a lot more closely. What are they at, 90 days now?
Well, they're Chevy's around 55, and then Cadillac is above 60, and then Buick is at 100. So like
So you
altogether,
have, you've had like all those, and that was at the level at the beginning of the year, right? So
no,
yeah,
this was at the level like a week ago.
Okay. So that's been
like a week ago.
But
yeah,
I mean, they've got that like huge buildup, which has frankly boosted their historical earnings.
Correct.
And now that you've got a glut of inventory sitting on there, and you're going to have to cut your earnings probably, or cut your production, presumably, as long as those other companies are seeing the same kind of headwinds that Tesla is, and they're probably seeing them a lot more significantly. I mean, and your margins are getting squeezed, and you're trying to transition to EVs, and like you're getting crushed on that side of the business and the ICE side. It's just like, there's going to be carnage here.
It's a perfect storm for them almost.
Yeah. So it's not great for Tesla. Like, Tesla is not going to post impressive earnings per share growth like a year ago I thought they would this year. But given the situation, like, it's just fantastic.
This is really, I mean, this is really shaping up to be a sort of for the next, say, 2 to 3 quarters, maybe 4 quarters, is shaping up to be a expect disappointing results, and check your signals to see if the long-term success of the company is still there. So check competition, see where they're at, check Tesla's FSD development, check their 4680 development, check their ramping speed, check their ability to lower COGS, see if they can still reach that 1.8 million unit at whatever margin, right? And the stock will suffer. And I'm curious to see what multiple the stock market decides to give Tesla in this environment, because if I'm looking at after hours right now, and if I pull up the price real quick, it's down 5.4% right now, I believe. So let me go ahead and share my screen. Yeah, so it's down 5.4%. So for folks that have, as Emmett was saying, bought this at the peak, then this sucks pretty bad. If they bought recently, obviously this sucks as well. Are you surprised by the movement right now, or was this based, is this kind of hitting your expectations based on how the company reported their earnings?
Yeah, it seems about right to me. I mean, the earnings per share number itself was fine, but the auto gross margin was certainly the weak point. And the fact that Zach basically provided guidance, which is going to force the analysts to go out and lower their earnings per share and like kind of margin assumptions going forward for future quarters. Like that's a kind of reasonable reaction for the stock, I think. I mean, he was saying how half the miss essentially was related to the price cuts that they introduced in the second half of the quarter, and then on top of that, there's the price cuts from today. So like if you kind of compound those together, that implies like a pretty decent drop in gross margins for Q2 and beyond. So even if they're reasonably successful in cutting costs in all the ways that Jeff was describing earlier, I don't think you're gonna be making a big dent in the gross margin hit that the just ASP drop's gonna require. So this seems about right to me, honestly.
It does seem like if macro doesn't improve or it doesn't stay flat, if we take again their guidance at their word, and based on my channel checks, it does look like the economy is suffering, especially from an auto perspective. If that sort of stays around where it is today, doesn't get any worse, it does seem like Tesla's margins could, get down to the 16 level at these levels, maybe 17 if you're lucky, but it does seem like somewhere between 15 and 20 is very much in play for the next few quarters from the auto perspective, and how quickly they can roll out FSD, how quickly they can realize the cost savings from Berlin and Austin, how quickly they can ramp up energy, which again, we're getting more and more signals from them as well around that business. It does sound like it's going to take a while for those facilities to recognize those 20% margins, right? That we got guidance on from Zach, really. This is the first time that we got that.
Too, yeah.
What'd you think about that?
Yeah, that was interesting. There was this whole like vitriolic debate on this 6 months ago or so, or even more recently, about like Tesla's going to have 50% gross margins on the energy side of the business, and they're going to be ramping to these crazy rates.
Should have given him credit.
Yeah, it was just like we were pushing back on all along. Now, I did kind of cave and say that the 50% margins are possible. Sounds like the guidance that they're providing is no, that like 20% is the goal. Could they be sandbagging? Yeah, but I'm kind of apt to take them at their word here. So, I think I forget exactly the margin that I had them scaling to, but it was certainly higher than the 20% gross margin in the modeling I've been doing recently. So, I've got to bring down the long-term kind of energy margins as well. But the opportunity is still like massive. It's like, all right, well, you've got 50 billion of revenue, and so you've got a $10 billion in gross margin at a 20% margin, rather than, I don't know, 15 or 20 if the gross margin were 30 or 40%. So it's like, all right, the Uber bull case take a beating there, but it's still way higher than where Wall Street is expecting it to go. So kind of good information. I'll have to go down and bring my modeling valuation stuff down a little bit, I think, to account for that. But still, the upside is very significantly there.
Yeah. Do you think there's starting to be sort of a recognition by some of these analysts that Tesla is not just a car company? Because I'm hearing more questions around energy. I heard the questions around Dojo. Do you think that's going to impact Tesla's ability to have a price earnings ratio that's continues to be significantly above the rest of the auto market? How do you think about that?
Yeah, I think it definitely will maintain that premium. So, right now they're at 50-ish, probably down a little bit now from where that PE had been. But like maybe the market decides they need to be at a 40 or a 30 or something like that. But like they should never be at a 10 or 15 or whatever Ford and GM are at, because they do have all these, even some people like who's that Drew. Can't believe I'm blanking on his name. The bear, Drew Dixon, calls them like the Musk options. Like these, Dojo and FSD and all these things, they might be worth something, but I can't value them, and I'm not going to bake them into my base case. And that's like a reasonable stance. But as they start actually getting closer on some of these things, like to me, it's like the most conservative thing you can do is just ignore them and say they're worth zero. It's not. I mean, the way that Elon described Dojo, I thought was pretty interesting, and kind of comparing it to Amazon Web Services, it was like that was something we thought they could do for a while. And I liked the way that he kind of framed that of it's not a sure bet, but if it is, like, man, watch out. So that would be another kind of catalyst that I didn't really have in my playbook, is if they start selling that as a service.
Do you think that includes the money they'd make from the training on FSD? Do you think that's how he's conceptualizing, or is it just purely talking about renting it out as a service? That multi-$100 billion number.
Yeah, I think he's talking about renting it out as a service. So I mean, he was saying like an order of magnitude decrease in the cost of training. So Tesla gets that direct benefit, obviously, in the kind of training that they're doing for FSD right now. But then if they have this architecture that's just like super efficient and cost effective, they can just essentially spin up a new version of AWS and sell that training capability. Which, I mean, imagine how much the market for like AI training hardware is going to grow in the next 5 years. And if Dojo just happens to be like one of the best architectures to handle that problem, My gosh, what is that worth? I don't know, but a lot.
No, for sure. Yeah, I think I'm curious to see how the market's going to process this. I do believe folks that have been sort of on the camp of, Tesla's going to continue to suffer here in the short term, and it's not going to be as rosy as it seems. I think those folks probably got a little bit of validation today around some of the short term, maybe even medium term potential price stock movements. But I am really curious to see how that shifts over into next year, because the guidance we got, again, if the company, this is sort of like the thing that I'm very glad they owned up to their sort of, not, I don't want to call it misguidance, but knowing that they gave guidance on the previous quarter and it has changed to the downside. Now that they've done that, I wonder if sort of like the guidance we got about next year looking better will actually take hold at some point. But it does seem like it's a lot of wait and see what happens, because that continued sort of, hey, we are uncertain about the macroeconomic environment. I mean, it's just, we don't have a crystal ball. Uncertain macroeconomic times, man. That was my biggest takeaway, is that they're basically saying, yeah, the economy is weird right now. We don't know what's going on.
Yeah.
And we're having a very tough time telling you what's going on. Yeah.
What did you think about Cybertruck delivery event in Q3? That sounds like a party.
That sounds like a party, boy. And end of Q3, hopefully end of Q3, I think was the actual verbiage that was used the second time it was brought up. I'm excited for that. I mean, I think it's another. It sounds like definitely this year. That's what it sounds like to me. Definitely, absolutely, the first Cybertrucks will be delivered this year. I hope. I shouldn't say definitely.
And definitely
it
FSD
looks
will
likely.
be solved. My car will be a robotaxi this year.
Yeah.
For sure.
Come on, Elon. Stop being so damn ambitious. It is funny how being so ambitious gets punished in the stock market in a way. But I guess it's because the stock market is trying to be a future pricing mechanism. So, I mean, that's why we get these moves, if you remove emotion. So, yeah, I'm pretty excited about that. I think that's going to be really good. They've sort of started hyping again how good of a product it's going to be. Calling in a Hall of Famer was good marketing verbiage. They say, hey, it's going to be a Hall of Famer. I'm excited, man. It's a brand new product segment for the car. We should start seeing revenues kicking in this year. I do wonder how much if the stock market will price it in at some point this year once those first deliveries come off the line. It will take a while to ramp. Obviously, but I do wonder if that's gonna, for the short-term folks following the stock, wonder if that gives them a little bit of a reprieve and ability to be a little bit happy and to look forward towards something that could be a positive. What do you think of it? What do you think of Cybertruck?
Yeah, I was just thinking today about, like, Em and I have been on this rampage about marketing and just how it just seems like, they're being a little bit stubborn about not doing it, given, I mean, just look at their margins. They're clearly paying a price for that stance. They explained it, so that's, fine. That's the way that they're going. But Cybertruck going on like streets, and like somebody who knows nothing about like Teslas or EVs or whatever sees that roll down their neighborhood, like what the hell is that? And it's going to start all these conversations. Like that's going to be a viral marketing, I think, sensation in a way that'll really help demand, throughout 2024 and beyond. So, I mean, I'm just so excited for that. I mean, I think it's exciting from the marketing standpoint. I think it's exciting just as a product. Like I frankly just want to get one and drive it around. And I think it's exciting because the demand is so high that I think it's going to be a boost to margins. Now, not initially. I mean, first part of the S curve, I'm sure they're going to have production issues. Even if it is super high margin, when you're selling 5,000 of them in a quarter, that's not going to do much on the overall financials of the company. But looking forward, and the markets I think are forward looking. You start seeing that impact in Q4 of this year or something like that, and then analysts are doing a ramp and saying, okay, yeah, this is going to be higher margin. Looks like we're getting out of the recession. I really wouldn't be surprised if we have a significant rally, latter half of this year. But not investment advice, and I've been dead wrong on that sort of thing in the past. So remains to be seen. But I don't know. I try to be very level-headed about all these earnings calls, and I know there's a decent amount of bad news in here, but I'm excited, honestly. Like long term, very exciting.
Yeah. It's It really does seem like they are starting to flex their muscles. I mean, this is pricing power. We've talked about pricing power, right? Many times before. If there was a situation where Tesla had to drop the prices to make stuff happen, they could, and now they are. And now the check is going to be checking everybody else, and like GM and Ford and Toyota and everybody else, as the company continues to lower price and hits more and more markets and more segments. The proof should be there over time that says, as they've continued to do this and they're retaining what they're saying healthy margins, which we're not quite sure exactly what that means, and what they're describing to be a bad macroeconomic time. Like, let's assume, I don't know, they have to get freaking prices another 10-15% lower than now, which might put them in single digit margins for the auto market. And if that's what happens, that's what happens. What's going to happen to everybody else, right? I mean, we should either see dramatically lower volumes from these companies to try and marry price to a lower cost structure and retain their profitability, or we'll see something similar where they go from single digit margins to God knows what margins, what sort of negative margins they might get, right? So I'm curious to see that dynamic play out. And that's going to be my way of testing the thesis, is that if you really think the macroeconomic environment is bad and it's impacting you and everybody else that's selling cars, we should see this everywhere else. And if we don't see it everywhere else, then I think it's a big question for Tesla that says, you're saying this, but I'm not seeing it from every other automaker. What's happening? But we are seeing it. You know, Q4, Q1. Q4 was flat with Q3. Q1 is down versus Q4. Q1 was a channel stuffing quarter, and inventories went from X number to that number. So we are seeing it. It's just the automakers haven't reported on it yet because they have that secondary layer of stuffing the channel with the dealership network, and now the dealership network's getting stuck with cars they can't sell. And that's the environment we're in now.
Well, and it's worth pointing out that Tesla is giving themselves a harder goal than the rest of the industry. I mean, like, Ford, GM, and all the incumbents are trying to just like not lose share. Tesla's trying to grow at 50% a year. Like, it growing 50% a year in a downward macro economy is like, if you just like chart it out like Econ 101, okay, supply is increasing, and demand is decreasing. That like very clearly implies a very sharp decrease in price necessary. So it's a really tough spot that Tesla's in right now, but I also don't think it's worth reading too much into it beyond that, the fact that it might be a more difficult 12 months than we otherwise might be expecting. So it's like really tough goal for Tesla, but like them trying to keep these aggressive sales targets is putting so much pressure on everybody else.
Yeah, for sure. Okay, do you have anything off the top of your head that you want to go through? Because I do want to sort of very quickly skim through the notes and see if we missed anything. Is there something you wanted to bring up before we did?
No, let's dive into that. Your note-taking skills are epic.
I wouldn't go that far, but I appreciate that. Let me plug in my mouse because it just literally decided to die. I feel like these mouses. These mice are their battery just dies so quick. Maybe my mouse is just a piece of shit. All right, here we go. So I have a link for that at the top of the comment section. I'm also going to put this in ChatGPT, and I'm going to do a summary and post it on Twitter. My God, AI technology is crazy. All right, so quickly, Elon remarks, Model Y best-selling vehicle in Europe, best non-pickup in the United States, despite a lot of challenges. Current macro environment remains uncertain. While we reduce prices in early Q1, operating margin remains among the best. Taking a view that larger volumes, larger fleet is better than lower volume and higher margin. We expect vehicles to generate lots of profit through autonomy, laying the groundwork as they perfect autonomy. Cybertruck building out versions on the pilot line. It's a great product. And a Hall of Famer delivery event in Q3 2023 is what they're going towards. We'll follow an S curve. Tremendous demand for the product. A Hall of Famer. Will take time to get the line going. Radical product. Megapack, great progress. Deployment reached at 4 gigawatt hours in Q1. Strongest quarter ever. Leather Factory is ramping. Autopilot and FSD, 150 million miles driven in FSD, which is such a big number. Number is growing exponentially. Data advantage no one else has. Those who understand AI will understand training data. Very focused on neural net training. Limiting factor for autonomy, continuing to ramp NVIDIA GPUs in Dojo. And then the Dojo potential is significant if they could use it as a sellable service, just like AWS, which he brought up on the remarks. It wasn't even a question. He brought it up as a
Yeah.
remark, which was fascinating. Want to make as many cars and sell as they can. Good time to exceed the lead further. And huge thanks to the Tesla employees. And real quick, Zach, congrats to Tesla team for record production and deliveries. Autonomy gross margin and operating, this is auto, excuse me. Auto gross margin and operating margin reduced but remain at healthy levels. Impacted by additional adjustments and warranty adjustments, so on and so forth. Berlin and Austin costs are also down. Storage business is starting to take shape. Approaches to grow volumes as quickly as possible. Focus on efficiency and doing things from COVID, so on and so forth. Any remarks there so far?
No, nothing I want to dive into necessarily. Anything stick out to you?
No, it's just kind of, we've kind of discussed it already. I think the Dojo thing was interesting. And there was, we already talked about it. Okay, so questions. What is the process of auto pricing adjustments? Don't really want to talk about it. We do our best to take our production output to macroeconomic environments. As a team, it's a team review where this team review is where we stand globally and can't get into details as to why we're making decisions, but it's actively managed. And then, do you still believe Tesla Energy will be bigger than auto? And then they said bigger than auto on total gigawatt hours deployed, not necessarily by revenue. Auto could be bigger. Seeing growth of energy storage well in excess of automotive. Guidance for margins on energy around 20%, just like any other program that they launch. Any comments there?
Yeah, I mean, we did kind of talk about that already, but it's a pretty interesting disclosure that we've had for the first time. You know, the one we didn't touch on really is the gigawatt hours. In terms of sizing of the opportunity. So kind of getting back to master plan part 3. He's saying we need more gigawatt hours for stationary storage than we do for what did he call vehicles, like moving vehicles or something like that, non-stationary
Yeah,
storage.
non-stationary. Yeah.
So I thought that was kind of an interesting way to frame it, and I hadn't exactly thought of it in those terms before. So I think what that's implying is obviously the pricing on a dollar per kilowatt hour basis will be higher for cars because they've got seats and all the other like steel associated with making a car, but the majority of the cells will actually be for stationary storage. So kind of interesting, and I think it was a subtle reframing of the way that he's discussed this in the past.
Great. How well are 4680 cells meeting expectations versus battery day? So they established a cost down roadmap through 2026 there. They're making good progress, hoping to get near production by the end of the year over at Corpus Christi for the lithium refining. 75% utility is installed for cathode in Austin. First material by end of year from that facility. And then structural battery pack, they've seen big improvements. They do believe that the structural battery pack is a good process and it still makes sense. And Q1 was all about cost of quality, significant improvements in both areas, 50% quarter over quarter in Texas, 25% reduction in COGS over quarter, and on track to achieve steady state targets by end of year. Any thoughts there? 4680.
Yeah, I think he also, didn't he say something about like a 20% increase in max throughput out of Cato, which
I believe you're
pretty
right.
Interesting. You kind of forget about Cato because now it's all about, all right, let's get it into production. But I mean, they're at 10 gigawatt hours, I think, right? Is the capacity in Cato, and I mean that's pretty meaningful too, especially when you consider the IRA credits that are going to go into those cells as well. So I mean, it's good to see that they're continuing to work on that process because as they get that up and running in future plants, I mean, the learnings at Cato are going to be pretty important too.
Yeah, great point. What do you anticipate 2023 gross margins for cars will be at current levels? And that was there were some really good questions on today's call, I thought.
Yeah,
like
I agree. They're better than usual.
Yeah, pointed, great questions. And it was great. And I thought the answers were quite good as well, mostly. So a difficult environment, lots of macro uncertainty, set of costs we control and some we don't. Within the bucket we control, most of the costs that we're working on is around the Austin ramp and stabilizing that. Cost optimization work to get on intended volumes there. 4680 cells is a big piece. Similar story in Berlin, doesn't have 4680 as input for that factory to complete localization is ongoing. As volume increases, more localization occurs. And then the world that we don't control, logistics, but moving in favor. Supply team is doing a great job. And then commodities are a huge hit point. It's still at maximum pain in the cost structure, but there will be more improvements in Q2, and lithium prices have fallen significantly. Let me just make sure I fix that. Fallen significantly, and then they do expect a bigger impact in the second half of the year. A lot of risk, but we have to see how the year progresses. And then, yeah. And so, any thoughts there on that guidance? We talked about it briefly, but if you have anything.
Yeah, the thing that kind of stuck out to me was just how different like the issues at each plant are. I mean, Shanghai is still kind of like the standard bearer and frankly an asymptote that the other plants won't get to in terms of profitability. But it's just kind of interesting that they're trying out different strategies. You know, like localization is this issue, and in Berlin, which kind of makes sense because the whole supply chain to date has really been in like U.S. based in China. So they got to kind of stand up something there that makes sense. That would be a harder problem, but I hadn't thought about that. Then 4680, we obviously know that's a huge problem and opportunity in Austin as well. So just kind of interesting to think about the different issues at the plants.
Then the question is, how is global ordering tracking? How is it tracking? How is global ordering tracking? My goodness, why can't I do this? Tracking since the most recent round of price cuts, orders are in excess of production. And that was really the guidance we got there. Hold on, we got Chili back. We got to bring Chili in here. What's up, Chili?
Hey guys, how are you?
What's up, dude? Okay. Dude, you look good with that beard. You gotta wear it more often.
I'm too lazy. I only like to shave once a week, I guess. I don't know.
I love it. What'd you think of the call?
Sort of as I expected. I guess the business is, great. I'm excited about the long-term business. The stock, I'm worried about for the near term. But I'm a long-term investor and happy to hold through thick and thin. But near-term stock movement, I'm very uncertain, could be trouble.
What was something that really jumped out to you during the call?
Well, when towards the end, actually, there was a question. I think Jeffrey's analyst or someone asked about margins again. Like, so you're willing to ask Elon to reaffirm that he'll, sacrifice initial margins for the lifetime value of the car. And Elon said yes. He reaffirmed it in the middle of the question a couple times. I don't know if you remember that part, but that just, I think they already sort of said that earlier, but I think it just really stuck it in there. Hey, we're going to have very low margins potentially initially up front, but the lifetime value is going to be huge. So it's just a question of whether I could be wrong about the stock if the market, if institutional investors are willing to accept Tesla similar to how they accepted Amazon for so many years with zero margins. How Amazon for years carried a very heavyweight valuation because they were investing all in growth and had very little or zero profits basically. And so investors looked past that and still gave it an incredible valuation. So if institutional...
The Russians got him. Chelly, we lost you. I think you need some more peppers in there or something. What do you think? What do you think of that commentary? Though. Oh, he's back. Oh no, is he back?
Yeah.
All right, we got Chelly back. Go ahead.
Sorry, I put my phone on Do Not Disturb. Get those spam phone calls.
My goodness.
So, I think if institutional Wall Street is ready to accept Tesla in a similar manner as a true disruptor, not just an automaker, and they're willing to accept Tesla to have very low margins that Tesla may need to have in order to ship 500 to 1 million cars a quarter, which they're getting up to that. Then I think Tesla's valuation could stay where it is or potentially go up. But unless if institutional Wall Street is not ready to accept Tesla in that way that they did Amazon for all those years, then I think valuations of Tesla is going to get crushed for the near term.
What's the likelihood that happens? How do you think about what does Tesla need to showcase for that to happen, or is it just literally up to the market to decide they want to do
market? I mean, to me, it's a no-brainer. To me, I'm not institutional Wall Street, but in the eyes, if I have to put myself in the shoes of institutional Wall Street, like Gary Black, or that's how he thinks, right? And he would be the good person to ask this question to. I would say it's I don't know, less than 50-50, that there's like a sudden change in how institutional Wall Street embraces Tesla as a company. They have to fit it into their models somehow, some way. And Amazon was only a bookstore for a short period of time, and then institutional Wall Street realized it's something much more. But Tesla, to most of institutional Wall Street, is still an automotive company. I think that's the problem.
Mm-hmm. What'd you think of their sort of verbiage around uncertain economic times? I don't have a crystal ball. Did anything jump out to you when they were saying those things?
Yeah, I think that was like Matt impersonating Elon. It was Elon impersonating Matt impersonating Elon or something. I thought Matt said that line or something. So yeah, I mean, that just to me is standard Elon. Uncertainty. He doesn't know what's going to happen with commodities, and just like a non-answer sort of.
Mm-hmm. Yeah, Matt and I were discussing that, and I thought that was kind of a very is a way of saying recession without saying the word recession. Like, hey, the car market is suffering. We literally have to continually drop prices. We're looking at prices every single day, and we are making sure that we're marrying up our prices to production as closely as humanly possible. And we are uncertain about the rest of the year, and we're willing to drop margins to zero. Doesn't that scream recession to you? Like a pretty severe one,
I mean,
potentially?
Or that they're just not enough of the general public is educated on Teslas to be willing to pay current prices for as many as they're selling. So, you can put it that way, where if Tesla were willing to educate the general public, then, they would just take away a lot of sales from other ICE cars that are selling for $50,000 or $40,000 or $35,000. But in the absence of a major education campaign to the general public, Tesla is going to have to drop prices more to sell twice as many units as they are now.
Mm-hmm. Matt, did you have anything you wanted to add or anything you wanted to ask?
No, I think it might be good to get back through the document. I think there's a lot of good stuff we haven't kept going through yet.
So let me go ahead and do that. So what we're doing, Emmett, is I took some notes, and now we're going through the notes, and we already went through some. So we're just going to continue going. If you want to add or add any commentary, please feel free to do so. So one of the investor comments or questions was, can you give us a specs on Cybertruck? We will save that for the delivery event, which will hopefully be around the end of Q3. I'm confident in saying that it's an incredible product and a Hall of Famer. And I said, hype train choo choo. So he's starting to really hype this thing up, which is great. Any thoughts on the Cybertruck stuff, Emmett? During the call?
I think Cybertruck is the biggest way to advertise, not educate. Well, it's going to cause curiosity. That's what you need to do. You need to cause curiosity either through education or something explosively cool like the Cybertruck. So if they can start shipping, 50, 100,000 Cybertruck a quarter, that might not be till early to mid next year, let's say, then that's when people are going to see them all over the road, and it'll kick off a ton of curiosity among all kinds of people to talk about it at the dinner table with grandparents or whatever, and that'll help bring a whole new wave of demand and such.
Matt, did you want to add anything else on Cybertruck?
No, I mean, it's a similar point to what I was saying before. So, I mean, I think it's a big deal. I think it's, potentially going to be a pretty big catalyst. So, I mean, it gets back to the same thesis that we've had that, the next 12 months are looking pretty rough, to be honest. But then the next 12 months after that I'm super excited about. So, it's interesting to see when will the market, will the market in Q3 all of a sudden start saying, hey, things are a hot mess right now, but gosh, look at, 6 months from now, things are really looking better. You could see the stock really rise in that scenario too.
Yeah. Like you might just have a really dark time for the next 6 months and then a nice rise after that. It's hard to say, or it could be a year until the stock starts rising. Yeah, it's hard to say, but I agree. There is a very bright pot of gold at the end of the rainbow if you can wait it out.
Yeah. Oh, hello. Does he have any
Gavin.
thoughts for us?
Oh,
Do you have any thoughts on the
do you have
Cybertruck?
any? Do you have any thoughts on the Cybertruck, Gavin?
How many kids you got over there? Like 7, bro? Jeez.
3. What do you think about the Cybertruck? They think it's the best ever. Okay.
Best ever. Okay.
Yeah.
Did they
yeah.
do independent research, or are they influenced by their father? Can you ask him that?
Do you do independent research, or are you influenced by me? Yeah, this is me. Yes, it's real. It's real. Yeah. Yeah, there's like 4,000 people watching, I think. So be careful.
Yeah. Famous.
All right.
Your words will be locked forever. It's all good. That was my wife in the comments. She's like, "Oh my God, so cute, little Emmets." It's awesome.
Yeah, they're all eating their French fries and ice cream before a baseball game.
Fantastic.
Yeah.
All right. Question from Piper Sandler. Lathrop, great to see growth. When do you think the facility will be close to full utilization? The comment was there are ramps at the facility with the suppliers. We should see that unlock in the latter half of the year, second phase in the second half of the year. And the follow-up was ability to serve customers out of Shanghai. Wonder what are the regions that you aren't serving effectively? And then the answer was many parts of the world that Tesla does not serve yet. Expect to open up new market throughout the world. Even though they are not gigantic, they do collectively add up to something significant. It's about time that Tesla offers its cars to the rest of the world. Any comments there?
No, I mean, I think the other thing that they were talking about at that point was the interconnect queues and how much those are growing. And I think it was kind of interesting to hear that, they're not really looking at that from a demand perspective. They're just figuring out how can they ramp supply. So kind of a similar analogy to to what's going on in the auto business, that like they're just going to ramp up supply as much as possible. And so right now demand seems infinite, but it could be the case that 3 years from now we're having the same situation on the energy side that we're having right now on the auto side, where they're just all of a sudden they're ramping up supply, and the energy industry for whatever reason is going through a downturn. And so it's just it's interesting. It's a huge opportunity, and I'm excited to see it ramp up though.
Emmett, anything from your side?
I agree with Matt. Yep. I'm excited to see how it ramps.
Cool. George from Canaccord, can you discuss FSD take rates given that you've reduced prices? Do you think you need to do that for FSD? No details on take rate, tricky pricing question. Value of the car that's autonomous is enormous. Price now is an option value on the autonomous vehicle. I think we will do FSD release later this year, and I'd put an LOL at the end because I think it deserves it. And then the follow-up was EV commodity prices. Do you think it's a reflection of overcapacity in supply? And then there was a lot of commentary around this. I wish I had a crystal ball, can't provide an answer. We are in uncertain times. Guess is stormy economic weather for the next 12 months, provided there are no major geopolitical wildcards. Things get sunny around spring next year. And then EV material targets, most are not super liquid. Fluid, maybe, I meant to say. Single percentage is traded. Oh, I'm talking about, what is this? What am I talking about here? There are large price swings in EV material targets. We are seeing softness in lithium carbonate. Could take advantage of low prices for the rest of the decade. We have contracts in place with previous pricing. Because of the price spike, companies are becoming more ambitious in finding places in Africa and South America. And then on the lithium front, the choke point is on refining versus mining. Lithium is very common, and the sort of same verbiage around, hey, like we just need refining capacity versus mining. Any thoughts there?
That last part we've heard ad nauseum over the last year or so.
Yeah.
So no, I still wish they would explain that a little bit more than they have to date. But it's not unexpected. We've seen commodity prices come down. Just how those translate into the earnings or the cost of goods sold will be interesting to track over time.
Thinks about it
Emmett,
with like forward contracts and such. Yeah. Can you hear me?
Yeah.
Oh, yeah. I'd be curious to see what Jeff Lutz thinks about that comment. I gotta go, guys. I gotta get going. But thanks for having me on again, and I'm listening to you guys while I'm driving my kids. I'll talk to you later.
Of course, man. Way to prioritize your kids over us, bro.
Yeah.
Wow.
I don't do that. Look, I'm here. My wife's single parenting right now.
All right.
As many kids.
Emmett's a better person. Take it easy,
All right,
Emmett.
see
Thank
you
you
guys.
for jumping in.
Bye.
Appreciate you, brother. Bye. That's great. See, that's how you are you have a good dad as an example there, Matt. Learn something. Jeez. My God, what a terrible person. Oh, man. I really do wonder how many people think we're serious. I hope nobody does. but I know some do on Twitter. It's very obvious. It's actually kind of very entertaining. Emmanuel from Deutsche
Well, you're
Bank.
contributing
Pricing
to population collapse, so thanks for screwing over humanity.
for now. Give us a second, bro. Like,
Okay,
just wait. You'll see.
I just know Cindy saw those kids, and we might be seeing many Farzads, 9 months from now.
Well, we don't know if that's a good thing or a bad thing yet. That's why we haven't decided if we should get cracking or not. Emmanuel from Deutsche Bank. Pricing strategy. Tesla feels it's worth maximizing volume and fleet, able to monetize this over a full life cycle of the vehicle. Can you be more specific? And so they kind of described this robotaxi terminology can be confusing. It applies to the next generation vehicle. They internally called it the robotaxi. But here, actually, I forgot to mention this at the top. This was huge. I think this is the first time we actually heard this guidance regarding full self-driving. All of the vehicles that have Hardware 3 will achieve full autonomy. Model 3 and Model Y will be a robotaxi. Current hardware can achieve full autonomy. What did you think of that verbiage?
Yeah, I think we did touch on that at the outset. Yeah, that was a pretty big announcement, because that was something, the whole Chuck Cook B pillar question was, it seemed like a pretty reasonable stance that you'd need a kind of hardware 4 and maybe even like a hardware 5, because it seemed like hardware 4 wasn't the big retrofit that some people were expecting that it would be. So, I mean, they obviously have looked at this in tremendous detail. And if they thought that there was a problem with the placement of the cameras, I absolutely believe they would have just come up with the hardware 4. It would have been very easy to just say, yeah, look, we thought hardware 3 would work for full autonomy. It's going to be a great ADAS system. It'll get you from A to B. It'll be like an FSD that will work, but it's not ever going to be autonomous. Like, that would have been a fine solution. Like, there wouldn't be legal action for that. I don't think any sticking legal action for that. But the fact that they're pretty convinced that they can improve the cars with just software is pretty impressive, I think. And the massive economic implications too. I mean, this is where he got to my absolute favorite line of the night. He was saying how at the point at which you can turn an existing car into a functioning robotaxi, the utility just increases exponentially.
Yeah.
And what I've just said is quite profound, and I don't think most people realize it. That was my favorite line, like the little humble brag, like what I've just said is so profound. No, that wasn't even it. It was the profundity of what I've said is quite remarkable. It was profundity. It was like chef's kiss on that. It was great.
Never change, Elon, if you watch this for whatever reason.
Yeah, no, never. I mean,
no one else says that. No one else says
but
that.
It's like so true. Like, that's, I mean, back in 2019, when I kind of went all in on the stock, I was like, yeah, you know what? Like, nobody thinks that this is like possible to like retrofit existing, not even retrofit, just software update, boom, you're like your
Switch.
car increases in value 4x or something like that at no cost to Tesla. Like, the margin implications of that just completely staggering. That thesis is still out there. It's just that most people are still not ascribing it any value.
I think what's fascinating, I'm starting to really wrap my head around is like, I think I now understand why people don't give that any value, is because Tesla does set ambitious targets and they do miss, and they do miss, and they miss, right? And but the important ones come to fruition late. And the really important ones come to fruition in just insane like 500,000 by 2020, insane, right? So, but I can see why that sort of narrative has taken hold, because 20% margin, 47,000 ASPs, nope. Full self-driving ready by autonomy by feature complete by the end of 2022, nope. But it's ambition. It's not giving you a false promise. It's like they're ambitious, and they just miss, and it is what it is,
Yeah, and I think if you go back to that Elon Musk series on Wait But Why from, I don't know, when was that, like 2014 or 15 or something like that. I think Elon at the time was saying that they were going to have the first manned mission to Mars in like 2018 or something like that with the with the BFR or something like that. And it's like, that was a wildly optimistic goal. They've learned a lot, but look, now tomorrow we're gonna have the first orbital launch of the Starship. Like, like massive thing that he's been talking about for a decade. It's finally going to become realized, now. And so, yeah, he massively missed the timeline of something that's so disruptive that it doesn't really even matter that the timeline's been missed. So, yeah, it's just the size of it kind of dwarfs any misgivings I have about how bad of a prognosticator he's been around timing.
Yeah, for sure. The one thing that always sticks to me that was told to me when I was a pharmacy tech when I was going to school, to college as my part-time job, it was, do you want it done now or do you want it done right? And I was like, wow, that was very profound. It was, the profundity of that statement was quite amazing. So
Were
I
you
learned
high
a lot.
at the time?
No, I wasn't. Wow,
A
I'm so
double
blown away.
rainbow.
Dude, throwing it back. That's a big callback. Double rainbow guy. All right. Follow up on the 20% gross margin. Sort of excuse me. So follow up, that 20% gross margin was reasonable given the guidance that we're giving at the end of Q4, but macro has changed. What else has changed? Is there a floor? And so the guidance was about half the miss is attributed due to adjustments in the second half of the quarter. That lowers the floor. Made adjustments in Q2 as well. The other half of the miss is attributed to things that are non-recurring, warranty adjustments, so on and so forth. And then there's two macro factors that are tricky. The biggest one is the interest rate. If there's high interest rates, it's equivalent to increasing the car or the price and less affordable. Another factor is when there's uncertainty, people will generally postpone big new capital purchases like a new car. If people are reading about layoffs, they might get worried. There's a slowing economy. Nature of the auto industry goes through cycles. Any thoughts there?
No, I think that's kind of similar to a lot of the stuff that we've already hit on. So I don't think we need to rehash that necessarily.
From Bird, many fish to fry.
Baird.
Dojo. How do we Baird? What is that? Bird.
You said
From
bird,
Bird.
and you wrote beard.
Beard.
I think it's B-A-I-R-D.
Jesus Christ. B-A-I-R-D. Baird.
Yeah.
Baird.
Not B-A-I-R-D.
Oh my God.
And A is the one English, that's like an O with a little foot.
Thanks. I was going to say English is not my second language, which is not, but this, I don't think, I guess, is that an actual word? What does that even mean?
No, it's a name of a company. It's
okay. Thanks.
Yeah.
Thanks, Professor. Appreciate that.
I'm a finance guy, so I know that.
Many fish to fry, like Dojo. How do we rank this versus the rest of the business? So they look at it as a long shot bet. If it pays off, it will pay off in a very big way in the $100 multi-billion-dollar level, which is something we discussed earlier in the call. But put in a long shot category, take it to the bank. But the banks, don't take it to the bank. And then he made a bank joke. Also, big believers in heat pumps and homes, but those are background items. They focus very much on vehicles, autonomy, and stationary storage. Solving the stationary, I don't know why they didn't tell me. Solving sustainable energy and autonomy is a huge focus. If Tesla can solve autonomy, the biggest value asset increase in history. And then the follow-up was around pricing, losing share, gaining share. How does Tesla look at pricing versus EVs or ICE vehicles? This was actually sort of a reiteration of how Tesla really thinks about why they're doing what they're doing. Every day, Tesla gets an update on how many cars were ordered versus produced. They have likely the most real-time data for their cars. Tesla knows how many were ordered
just
yesterday.
Like I said.
Yeah, just like you said. It's very true. You call that to the freaking T. Tesla knows how many were ordered yesterday throughout the world. The finger is on the pulse. There's no latency. Adjusting course every day. Decisions are pretty good. Sometimes they are dumb, but on average, it's better than the rest of the industry. And then as far as EV market share goes, a lot of the public debate is on this concept. Tesla doesn't look at it that way. They look at it as the car market. Mission of the company requires ICE to be switched over. Any thoughts there?
No, I mean, I did think it was funny that they basically said, like, we're tired of you guys looking at it wrong. We've been telling you for years, like, it's the whole car market, not the EV market. So do your job right is basically what they were saying. I thought it was pretty funny that wasn't even Elon, I think, that said that. It was
somebody else.
Yeah, it was somebody else. I'm not sure.
I think it was Lars or somebody else. It may have been Lars.
Yeah.
I can't remember.
It was just kind of funny seeing, one of the, sub Elon people being so testy with
snarky,
with the analysts. Snarky. Yeah. It's it's great that they feel that comfortable to kind of, push back in that way. I think it's good. I like to see that just in the depth of bench, like we saw on Investor Day, just having, so many people that are comfortable in their own position to not be afraid that they're going to say something that'll get them in trouble.
So true. It's funny because Elon wasn't snarky at all in this call, and a non-Elon person was snarky. You know?
Yeah,
I like that. I like
that's
that.
flipping the script for sure. Yeah.
I love it. Progress. See that? Come on now. Can you talk about the cost structure? This is from Oppenheimer. Can you talk about the cost structure that is available on cars? And then again, they would like to have a crystal ball, but they don't have it. Depending on what scale you're looking at, most of the car cost is variable. We've started seeing improved costs from suppliers. Some of that has flown through lithium production, commodity pricing. We're very focused on the metrics, and other things like reducing air expedites, so on and so forth. And then around stationary storage, can you talk about the volume of quotation that you're seeing and how many are converting to actual sales? They're not really looking at it that way. They're engaged in ramping Megapack as quickly as efficiently as possible. And this is not a product call, but we're making improvements. I don't know what that means. Making improvements on how quickly you can connect Megapack to the grid. Yeah, and so that was sort of like, this is not a call for new products. I think this is not a call for new products, but making improvements on how quickly you can connect the Megapack to the grid. Any thoughts there from those?
Yeah, I mean, it was kind of interesting because I would have loved to hear a data point about like, oh yeah, since the IRA passed, we've seen like a 30% uptick in orders or something like that. I think that's what they're trying to get at. Tesla's kind of in this spot where they don't have to give that level of detail. I mean, they've got a 3-year backlog. I mean, they can just say, yeah, all that matters is production, and that's a fair answer right now. But I just anecdotally or just out of my own curiosity, I would have been interested to hear, if they did see some kind of spike after the IRA passed.
Cool. Goldman Sachs, do you still see 2 million as a goal, and is 1.8 million supply or demand constrained? These are volatile times. Again, production standpoint, if things go well, shot at 2 million. That's the upside case. They feel comfortable at 1.8 million. Have to see how this year unfolds. And then in Investor Day, opening up the charging network. What are you hearing and how is it ramping? And then there was a comment about how they opened their first V4 in Europe, supercharger, and the Magic Dock in the US, heading towards universal compatibility for all vehicles in all major markets, balancing ability to serve current customers versus new customers. And this was an interesting data point. 50% of superchargers in the EU are all EVs, and 0 increased in wait times. So they've essentially, that's a pretty significant data set there. Any thoughts around this?
No, it's kind of interesting. I think they said in the deck that this is not like a big cash cow for them, but they're seeing some incremental margin. I was actually surprised with the margin of the services business overall. I was expecting that to kind of revert back close to 0% gross margin, but instead I think they made around 100 million of gross profit on services. So that's like a nice little adder. And to Elon's point earlier about trying to get all their lines of business to that 20% gross margin, that certainly applies to the supercharging as well. So it is small right now, but it's going to be kind of similar to what he was saying about adding all the different geographies. Kind of helps increase demand overall. And I think when they start ramping up all these other parts of the business, it's like 200 million here, 100 million here, and you start ramping that up, and that starts to make a somewhat meaningful impact in the financials as well. So I'm just kind of glad to see services progressing better than I thought it would.
Cool. Wolf Research, leveraging cost position as others struggled and lifetime revenue. Can you give us a sense on how far you'd be willing to take this? Are there brackets around a range of initial margin? Any color you can provide on updated margins, updated range of margins? Difficult to say what the margin will be. Depends on what macro dictates. If the Fed were to lower rates, that would be great for demand. I'd be very optimistic about middle of next year into next year. Important to invest in 2024 and 2025 today, using cash generated to invest back. Caution, don't read too much into recent quarters. Macro is very uncertain, kind of saying that the economy's poop was my verbiage. They didn't say that. And then the follow-up was long-term revenue. No, they did not. They did not use the word poop. Okay, yeah. That would be very professional. Long-term revenue of the company is massive. Sounds like you would be comfortable with a lower margin, and Elon said correct. So in a recession, pricing elasticity deteriorates. How do you view it in this context? And so cannot emphasize enough the question of affordability. For most people, it's all about the monthly payment. Banks are not leaning forward to provide loans these days. Tesla is in a uniquely strong strategic position, only ones making cars that they can sell for 0 profit for now and yield tremendous economic in the future through economy. If they chose to do that, it is extremely significant. So, the profundity of this statement that came from that. Any additional color there you want to give?
No, I think we did already touch on that point. So yeah, it's I am extremely profound, and I wish more people would listen to me.
All right, we're down to the last 3 questions. So from Morgan Stanley, hi everybody, good luck tomorrow with Starship to Elon. Now that you know Twitter really well, what can you tell Tesla shareholders about X or the super app? And then the very brief comment, it could potentially make it easier to buy cars. Kind of out of topic, there's probably some benefit. The follow-up was, back in 1913, Henry Ford introduced assembly line concept. Car costs fell 70 to 80%. Is history repeating itself? And then Elon said, we're not trying to take pricing actions to undermine competitors. We don't think about competitors that much. Do people like, we think about, do people like our cars? Can they afford our cars? We do have a unique strategic advantage, possible to sell at zero profit with net future cash flows and service and charging and insurance. We want all EVs to succeed too. We're trying to be helpful. We want to help them in any way we can. Any thoughts there?
No, I mean, I thought it was good. I mean, if he came out and like, yeah, we're trying to crush the competition, I mean, that would not be a good look. And frankly, we all know it's not true. I mean, it was kind of a silly question. If you're following the company closely enough, you know that from the beginning, that's never been their goal. So, yeah, I mean, I did think, Adam Jonas had actually watched a couple like videos like from connecting the dots. I know was doing some Highland stuff, connecting it back to 1913 or whatever it was. So that was kind of interesting to hear that comment, but I don't think we got any kind of useful tidbits from Elon out of it.
Yep. Second to last question for Barclays. You're ramping supply at Austin and Berlin. Help us understand how critical it is to ramp those factories in current macroeconomic environment. And then there could be a macro shock that is so severe that folks stop buying cars. But in the absence of that, we will continue to grow output at a rapid clip. And the margin at Berlin, margin drag until intended volume. Can you remind us of margin profile of Austin and Berlin versus Shanghai? And then I think this is the first time we got this guidance. Probably won't be as good as Shanghai, but we expect to make significant improvements in Austin, Berlin, and Fremont. We'll continue to increase our localization efforts. What do you think about that?
Yeah, I think we touched on that one a little bit earlier too. Actually, the Shanghai kind of being the standard bearer and the asymptote that other plants are going to get to. So, I mean, that was something when I was thinking about my modeling, it was like, oh, you saw how huge the margin improvement when they ramped Shanghai was, but that was when you're going from Fremont, like the worst, to Shanghai, the best. But now you have this like weighted average portfolio of production where you've got Shanghai and Fremont together kind of like setting this blended rate, which is, I don't know, probably close to like 20-21% now with his price cuts. And then Berlin and Austin are kind of dragging that down a little bit. So even once, like if Shanghai right now is at, I don't know, 26 and Fremont's at 18 or something like that, what they're saying is, we're never going to get back to the 30% range essentially that we had last year, unless the whole macro changes pretty significantly. So yeah, I think that's going to force some changes to the kind of modeling that people are doing, and it makes sense.
And then the last question from Jeffries: we should look at Tesla in terms of auto market share. Is there a limit to the direct business model? Should we look into different ways of offloading inventory? And then Elon's guidance seems to be working well so far. We're always going to have growing pains depending on the geography. It's helpful to have feedback with service. We feel the pain and know how to change the car so it needs less service. Best thing for the customer is no service. And then the follow-up was, fair amount of profit comes from service parts from legacy. Would Tesla think about doing that? Elon went on a tiny little rant before the end of the call. People don't understand that the reason incumbents succeed is because they have a large fleet and are able to sell new cars at close to zero margin and sell spare parts at very high margins. The only way to succeed for a newcomer is to offer a car that is so compelling they have to pay a premium over incumbent cars. In absence of EV and autonomy, a newcomer cannot succeed. Any feedback there? Anything for?
Yeah, I mean, I thought these questions were both kind of dumb, honestly. It's like, I could have really used a Pierre Farragut to round it out.
Yeah.
Like, okay, like these are not meaningful questions. I think, like, no, we're not going to do a dealership model, and yeah, we don't have a service business model that's really meaningful. And yeah, that was a problem for us, but we overcame it. So I think the interesting thing is not the question so much, but like their kind of response of like, yeah, the only way so we know like legacy is dead. They kind of established that. But the only way for a newcomer to succeed is for them to offer something so compelling or that's autonomous. And they also said that the only way to be successful in autonomy is to have a massive data set, which nobody but Tesla has. So it's like when you start putting the pieces together, it's just like they are just a wrecking ball in the industry right now. And I don't know how any other company survives, or maybe they survive, but at like 1% gross margin or something like, or not gross margin because you can't survive with that, but 1% net margin. So I don't know. It's just if I'm just taking my investor hat off and just watching this as a business story, like I want to pull out the popcorn and just watch how this unfolds over the next 5 years, because I have a feeling it's going to be bloody, and I have a feeling it's going to look a lot different 5 years from now than it looks right now. And I think that's what that answer was kind of getting at, is like, this is not going to end well for a lot of people.
Yeah, I couldn't agree more. I think it's going to be very important to separate out, especially for the next 9 to 12 months, Tesla the stock and Tesla the company, because there's a potential that there's going to be a pretty drastic decoupling. But I think as Tesla continues its mission forward from a very good financial footing, with lessening margins for sure, but with enough cash flows to subsidize the business growth at their targeted 50% year over year on average, and bringing out the Cybertruck and bringing out the compact car and building out Giga Mexico and building out Berlin and building out Austin and building out Shanghai, and developing full self-driving and ramping up energy, and they can still add cash to the bottom line, or at least stay even, while everyone else loses sales and they continue to grow. How could you not like that company? And so the question becomes, what is the market going to give it from a valuation perspective? And that's really the $1 trillion question, is like, how is the market going to value this business into the next year or two? So I'll be interested to see, man. It's very interesting times. It does really seem like Tesla, the company, they are very much firing on all cylinders, I think, in the respects to really fulfilling the mission of the company, which is to advance the advent of sustainable transport and getting costs as low as humanly possible and going down that cost curve. It's just we're in this weird time where profits will suffer because of it. And we also have a macroeconomic environment that is very much recessionary, in my opinion. So, yeah. Any parting thoughts before we wrap this up, Matt?
Yeah, I saw something in the comments that I just wanted to know. So, how does your iced coffee still have ice cubes 4 hours later? What's going on with that?
So actually, what's funny is producer wife brought this for me as we were wrapping up the call, the earnings call.
All right.
Yeah, and I've been sipping on it because it is kind of late. It's 6:40, and I shouldn't be drinking caffeine this late because I probably won't be able to sleep.
Well,
so I'm trying to
hats
like
off
jolt my
to
system.
producer wife for that multitasking. There was a lot going on there, and this has been a marathon. So
Yeah.
seriously, well done to
Yeah.
producer wife.
She's killed it.
Can
I
other
think
people call her producer wife, or is that
Yeah,
weird?
everybody. No, that's her
Everybody?
name, producer
Okay.
wife. Yeah. She doesn't have a name. Yeah, it's producer
Her
wife.
name. Okay.
I get yelled at so many times in the comments. They're like, you should call her by her name. You're such a misogynist. It's so weird. Like, you're such a bad person. I'm like, maybe she wanted me to call her that. Have you thought about that, bro? Have you thought about that for once? But it's
Yeah,
okay.
we're
It
so
is what it is.
respectful of pronouns these days. You would think that would be the first question. Is like, is that the name that she wants?
Exactly. Why are you assuming I should be calling her something else, bro? Come on now. Crazy. Anyway. Yeah, dude, thank you so much, man. This was over 4 hours of your time. And so thank you so much for making the time for us. And yeah, man, I appreciate you. I'm sure we'll talk a lot in the coming weeks and months, and let's see how this thing unfolds. But where can people find you and Emmett? You want to give them a quick pointer to where they can find you?
Yeah, so we've got our weekly Good Soil live stream. So it's Tuesdays at 12:30 Eastern. So it's I'm at Matt Chasm Matt. Don't even try to find it on there. I'm sure there'll be a link in the description. Emmett's at Emmett Peppers on Twitter. I've also been doing a lot of work with Bradford Ferguson lately too. So I've been doing some stuff with him, did a pretty detailed Tesla report with him too. So I'm all over the place these days, but it's exciting times for sure.
That's
I
awesome.
only wish
man.
we'd gone 8 more minutes, because then it would have been a 4-hour, 20-minute live stream.
Well, maybe for Q2 we'll push it a little bit further. All right, everybody. Thank you so much for joining us. Thank you, Matt. Have a great night, and we'll see you tomorrow. Take it easy, everybody. Bye bye.